The stock market rallied because the bond market rallied. And that's just not typical.
Growth keeps surprising on the upside, and that might continue.
Markets are a little bit more volatile right now than the underlying economy is.
It's going to be slower, but I don't think we're about to go into global recession.
It always looks like a soft landing just before a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
8-day winning streak on the S&P 500, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market positive by 0.2% on S&P 500 futures. TK, if we make it day 9, that's the longest winning streak going back some 2 decades on the S&P.
Sure, it's really humbled. There's no other way to put it, and it's the way we're doing this. It's a persistent bid, including this morning. Futures up 10, all of that happening in the last 20 minutes. Bramo walked on the set. We got green on the screen. But the basic idea here is it's a lot of micro stories wrapped around one thing, starving for growth. Microsoft off October 1-ish, up 17%, just as one example, $2.7 trillion market cap.
Record high. Meta up by 165%. TK Nvidia up by 218% year to date. You want some happy talk? Look to the outlook from Goldman Sachs and Jan Hatzius. I'll give you some happy talk. The hard part is over. We continue to see only limited recession risk. Lisa, more disinflation is in store over the next year. That's the view from Goldman going into 24.
A lot of people would agree that more disinflation is in store. The flip side is, what accompanies it? And the idea that the worst is over. The worst of what? Are we seeing economic softness? And this really is the question, especially given what we heard from Michael Daugherty yesterday and the ticking higher in unemployment rates that really isn't seen unless there's a recession ahead.
And just as importantly, Nick Benenbrook at Wells Fargo talking about 2.4% global growth, which is, by any definition, a recession. I think Arian lectured me on that years ago. And the answer is, you're right. You get a slowdown off of a deflation or disinflation. But this news overnight of Chinese disinflation and outright price decline, that redounds across the world. And what does it mean? People starving to find growth.
So as you know, pork prices, Tom, at the epicenter of that. And as you know, there was a hope for a demand boom that didn't materialize in China. 2 things happened yesterday afternoon. One in the bond market, the other in the commodity market. A break of 450 on a 10-year yesterday, yields lower.
Yeah.
That's the bond market. In the commodity market, a break of 80. Tom, a break of 80 on Brent. How quickly, how soon before we're sitting around this table and we're talking about not support from lower yields, but fear? Because lower yields mean something about the outlook for growth.
And that's going over to what Lisa said about economic slowdown. I mean, let's be clear here. The bond market, I was riveted at 1 p.m. yesterday over that successful 10-year auction. We'll have a full report from Bramo here. It'll take the entire 7 o'clock hour on the damn auction. But the answer is, yeah, there's a growth fear, but an economic growth fear, but in the meantime, you get a search for growth, and that's where you see Microsoft and the rest of them bid.
I do think, though, and I am deeply humbled, this is the year of narrative roulette. And we're talking about a slowdown in demand that was behind possibly some of the oil price decline. And then the head of the energy ministry over in Saudi Arabia came out and said that demand is not weak. People are pretending it's weak. It's all a ploy. This in a press conference just a couple hours ago.
Well, blinking it will change again anyway. Wait a week. Equity futures on the S&P 500 positive by 0.2% this morning. Let's whip through the price action together. In the bond market, yields bouncing back by about 3 basis points, 4, 52, 55. Similar story in the commodity market. Crude higher here, Lisa, by 0.7%, $75 and about 90 cents.
It's been such a quiet week for economic data. Today, we actually get initial jobless claims. It'll actually matter that much more simply because we've gotten no other data of note this week. 8:30 a.m. it comes out, and it comes at a time. Michael Daugherty yesterday of MKM Roth pointing out that unemployment has risen by 0.5 percentage point over the past 6 months or so. That has never happened, he said, without a recession following on. And that, I think, is important to watch. 1 p.m., U.S. Treasury selling $24 billion of 30-year notes. This follows the, yes, successful, Tom, auction yesterday, but it wasn't screamingly successful. The more interesting thing was it just wasn't a failure. And that's all the market needed to rally.
No, that's dead on, and that it was not a failure, and that's the fear. And John, that is the gloom crew that's out there life goes on, even with $1 trillion of annual interest payment.
You can say it looking at Bramo.
I can't say it.
The groom clue's out there.
It's okay.
It's like, folks, this is like in the movie My Favorite Year with Peter O'Toole, the guy in the green room when they're planning the shows can't talk to the idiot, so I can't talk to Bramo, so I'm like, John, tell her she's wrong.
At 2 p.m., Fed Chair Jay
Lisa,
Powell.
no, carry on, please.
Fed Chair Jay Powell is going to be speaking at an IMF panel that also includes IMF's Geeta Gopinath, Harvard's Ken Rogoff, as well as the governor of the Bank of Israel. Should be interesting given some of the recent developments, and moderated by the IMF's chief economist. Does he say anything? Yesterday he did not, as expected. Today, does he come out and give a framework of how he's looking at the economy and what the threshold is to cut rates, because that is currently a big point of the discussion.
I'm going to front run the chairman quickly here because we've got such a
Please.
wonderful guest, Ken Rogoff. I want to hear what Ken Rogoff says about the new debt and deficit dynamics.
You'd rather
of this
listen
nation.
to Rogoff than Powell today.
That's true.
That is so Tom Keene.
I would
that is the most
rather
Tom
listen
Keene
to my
thing
good friend Ken
ever.
Rogoff.
Chris Marangi joins us around the table, Co-Chief Investment Officer at Gabelli Funds. Chris, good morning to you.
Great to be here.
You're a man who's participated in this rally over the last week, so let's talk about it. I mentioned Meta, massive year-to-date gain up by 165% or so. Are you still in that name? Are you staying with that stock?
Yeah, we are in that name. You know, they live off of advertising, and Tom mentioned scarce growth. They're a company that's growing. Most of the other media industry, we're seeing sleepy top lines. It's harder to grow. And so, yeah, that's getting a premium. It's not that expensive. They'll earn $20 next year. The outlook is good. They've got a lot of costs yet to cut.
It's amazing to see what they've been able to achieve. Top-line growth, even with those deep, deep cuts. Mm-hmm. You said there's more cost to cut. What kind of numbers are you thinking about?
Well, listen, I think they've got a lot of cushion. You know, on the last call, they signaled that they are going to still continue to invest in the metaverse and AI and other initiatives, and we'll see that. But again, growing top line gives you a lot of room to do that.
Mario Gabelli invented all of this, and it was wrapped around securities analysis. You've got all those manila folders behind your desk folded up with each stock that you follow, just like old school. What do you do with what you own, Berkshire Hathaway, and their massive cash buildup, or the massive cash buildup across all of corporate America? Warren Buffett has a size of cash that's just surreal. How do you buy that? How do you own that?
Well, you know, Warren Buffett is probably the greatest capital allocator of all time. And if I'm going to give cash to somebody, he's somebody I'd want to give it to. He's got a great team. They own a great set of businesses with a lot of reinvestment opportunities. So, you know, that's why we're comfortable there.
What's the catalyst here? I mean, you look at Apple. So what was I saying? Apple's going to buy somebody, ESPN, or whatever. I mean, you guys have been doing this since time began. What is the new thing about all that cash that people like Warren Buffett holds?
Well, it's the opportunity, maybe not today, but maybe in a few years, if we enter a recession, market structurally changes, and he's left there with a pile of cash, and it's harder for PE guys and others to borrow.
One thing that's gotten really clear to me is it's very difficult to know what to price in some of these tech names, in some of these entertainment names. Is it going to be the story of just solid revenues like with Meta, or is it going to be the hope, the promise of new technologies? Jeff Katzenberg, the former Disney chair, said overnight, he was talking about the potential cost reduction of the use of artificial intelligence to create animated films by a factor of 10. How do you price that out for some of these entertainment names?
It's certainly very difficult to do. And it's, you know, one of the reasons that you've got NVIDIA and others and Meta and Google reaching such highs is because nobody else knows what to invest in to take advantage of this AI boom. So, you know, I think AI is going to have a much bigger impact on the back of the office. That is things like production, customer service, and others than some on the customer-facing front.
No one knows what else to invest in order to take advantage of this. No, I mean, I want to delve into that, right? I mean, is this basically a default? We know it's going to be big. Everyone tells us it's big. Buy NVIDIA, buy Apple. I mean, is that essentially what we're looking at?
I think it's as simple as that in many cases, yeah.
Okay, so then at what point do you know it's bubble versus something real? When do you need to start seeing the revenues?
Well, yeah, I mean, that's always the question. You never know when the bubble's going to pop. And I don't want to call AI a bubble necessarily, but it clearly has been important to the performance of the Mag 7.
Let's pick out a name that reported yesterday evening, the Walt Disney Company. The cuts taking place there. I believe that Bob Iger and the Walt Disney Company announcing an additional $2 billion of cuts. What do you make of the strategy right now over at Disney?
So Bob on the call talked about going from fix to build. And I think that's kind of the headline. You know, he stabilized the business and is now focused on reinvesting in the parks and in the studio, which has probably been neglected for the last few years. So
profit growth for the park business is just phenomenal. Looking at the numbers yesterday,
the parks business continues to be phenomenal around the world, both for Disney and for Comcast. And the question is, how cyclical is it? Because historically, this has been a cyclical business. And when the consumer runs out of money, are they going to stop going to the park? Because it's an expensive, obviously, proposition.
The public doesn't care what Mario Gabelli and you invented. They don't care about individual stock analysis. I'm going to buy an index fund. You two guys, your thoughts on the preponderance of index funds?
Yeah, this is a great question. And obviously, the flows have been to passive. Somebody needs to do price discovery, and somebody needs to be rewarded for doing price discovery. And price discovery can be very painful. And that's what we do. And, you know, in an imaginary world where it was all passive and there was massive inefficiency, that wouldn't work. So at some point, it leads to opportunity. War
story, folks. One day I'm with Mario. Years and years ago, I was a huge shareholder of the Gabelli Equity Trust. Full disclosure, I don't own any of it now. But the answer is you had Cadbury Schweppes. And like 2 days later, boom, it was taken out. I'm looking for a great zombie roll-up. Are we going to see takeouts in banking, beleaguered banking? Are we going to see takeouts in media after the train wreck known as Warner Brothers Digital yesterday? When's the Gabelli roll-up happen?
There's going to be consolidation in media for sure, especially amongst the streaming names. Don't know when that happens. It's probably over the next few years. Obviously, you have an FTC, which has been allergic to consolidation. That, of course, may change, but it's inevitable.
At this point, when you take a look at the suite of particularly entertainment names, just sort of piggybacking off of the Disney earnings yesterday, who do you think are going to be the ultimate winners?
Well, you think about who has a seat at the table for streaming, and clearly it's Disney, it's YouTube, which is soon going to be probably the largest video distributor in the country, and you know Warner Brothers Discovery certainly has a case to be made there. What happens to Paramount and AMC and Peacock, you know, remains to be seen.
ESPN, we were talking yesterday about Apple potentially taking it out. Yesterday, Bob Iger saying that it would be a standalone streaming business by 2025 and talking about that as one of the main pillars of the company. What do you expect to happen there?
Yeah, so sports, you know, talking about sports rights. Sports is tribal. The ratings have held up quite well. And so ESPN has actually done, you know, better than the general entertainment linear business. So it is going to be a direct-to-consumer business. How it gets priced and how big that market is a question, but it's going to happen and they'll find their way there.
Are you impressed with Liberty?
Liberty Media has been a holding for many, many years, much like Berkshire Hathaway. John Malone is the Warren Buffett of media. They're having their big meeting today. We like a lot of the businesses within Liberty Media, including Formula One, but especially the Braves, which is one of our larger holdings.
What are the questions you've got for him today?
Well, I think, you know, there's a question about what happens in cable as we see wireless convergence. How do the cable companies compete in that world where so much is wireless? That's a big one. And, you know, what's the future of media? How does streaming fit in with the linear business?
And the future of Formula One, TK. Hearing a lot of stories about reduced ticket prices, reduced hotel prices in Vegas going into next weekend.
Well, they got some challenges. Let's sell, John, our conversations here over the next 2-3 days. We've got two heavyweights lined up.
Two
in
fantastic conversations
of Las Vegas.
Christian Horner, Red Bull, tomorrow. Yeah. We'll catch up with Mr. Horner after their big victory this season again. Yeah. And then Mr. Toto Wolff.
You know, what's great about
Mercedes Racing next Monday.
What's great about this, you know, you think about horse racing where you got to fix a horse for the next season. How does Red Bull improve on their car over the season? Folks, I asked one question. I mean, I'm so dumb on this. It's like one question, Bramo and I give it over to John. But this is great, back-to-back Red Bull and Mercedes.
Well, you've got a very different question on Monday. How do you close the gap with Red Bull? How do they close the gap?
How do you keep Sir Lewis happy would be a small
I agree,
matter.
Especially with George Russell coming up as well. Yeah. Chris, this was fun. Fantastic to catch up with you, sir. Thank you. Chris Morangi there of Gabelli Funds on the latest on his investments, Tom, participating in this massive rally we've seen over the last week on the S&P and beyond.
I got a huge comfort in this, folks. And I know everybody's out there buying index funds, but the answer is this is what Mario and Chris invented, actually looking at companies and then having the courage to hold them until value is discovered. That's what he's done with Berkshire over the years.
We'll continue this conversation in the next hour. Julian Emmanuel of Evercore ISI. We'll catch up with him in about 50 minutes' time. If you are just joining us, yields are higher by 3 basis points, 452.74. Equities advance following the longest winning streak in 2 years. Can we extend it on the S&P 500? From New York this morning, good morning.
I don't think, Israel is interested in a ceasefire at this point. Hamas is not interested in a two-state solution. They are dedicated to the destruction of Israel. I think there needs to be new leadership of the Israelis and the Palestinians in order to have any chance at some kind of peace deal, especially a two-state solution.
That was the former U.S. Secretary of State Hillary Clinton speaking with Bloomberg's editor-in-chief John Micklethwaite from the Bloomberg New Economy Forum. More on that in just a moment. Welcome to the program this morning. 8-day winning streak on the S&P 500 could well become 9 if we make it day 9. It's the longest daily winning streak going back to 2004 on the S&P 500. Futures inching just a little bit higher by 0.1%. Came down through some interesting levels yesterday in the bond market. The 10-year, a break of 450 into the 440s briefly. Only a few weeks ago, we were talking about 5% through 5%, right the way back down 50 basis points or so. Higher this morning by 3 basis points. Bit of a reversal in the crude market as well. 75.74 on crude this morning. Higher here, Tom, by 0.5%. After breaking into the 80s yesterday on Brent crude, we're at $80 flat right now, positive by 0.6%.
Hugely important. Let's remember that's a global price, clearly affected far more by Suez Canal and Eastern Mediterranean geopolitics. John, what I would emphasize with the rally that we've had is the real yield. We've lost scope and scale. If you'd asked me 6 months ago about a real yield at 2.18%, I'd go, world's going to change. Now I'm going from 2.50 down to 2.18, and the world changes for the better. Small business gets some breathing room here.
Can we leave behind the fears of a couple of weeks ago? Can we move
Bramah,
on that quickly?
Think?
I just think that, does it really matter for businesses if on paper something goes up 0.5% and comes down 0.5% before you have to change your financing goals? I mean, at a certain point, it's moving so fast, people are paralyzed and wait to see what happens tomorrow.
I felt the same way, Bramah, when I saw mortgage costs.
Exactly.
The price
no one's
for mortgage
actually
coming down from 8 to 7.
I mean, great.
Like, yeah, sure, get straight on the phone. Let's buy that.
Exactly.
No, I'm not sure that's how it works, Lisa. I'm not sure that's how it works, Tom, in a real world.
No, yeah, we're just simply going to have to see. John, what's more important, November 25, Alabama, Auburn, or December 6, the 4th GOP debate at the University of Alabama?
I mean, I'll be watching Bama, Auburn.
Bama,
sure
Auburn.
Many other people will be as well.
To get us to the next GOP debate, Jennifer Flitton briefs, head of U.S. Government Affairs at Invesco. Jennifer, what will you look for December 6 at the next GOP debate?
Oh, well, I think I'd be looking to see who's going to be on that stage. Each step, each next debate has more restrictive thresholds. And so yesterday was interesting because you had only 5 folks on the stage, and they really had more time to get at each other, but to also get their message out. So I'll be interested to see who's on that stage come December.
Civics 101, are they all running for vice president?
It certainly feels that way, especially as we look at these polls and we see no one really taking any of that Trump margin out. He's 30 plus, depending on the state. And even in Iowa and New Hampshire, where voters are very focused, they take their responsibilities as the first caucus, the first primary in the nation, very seriously. They're very focused on this primary. And Trump really is just continuing to reign in those states.
Jennifer, do Republicans have a messaging problem around abortion?
Well, I think this week was a reality check for Republicans in Ohio, in Virginia, in Kentucky. They're going to have to try to find some way to approach this going into 2024 that mitigates some of the problems they're having with referendum. Because if you look at the Democratic playbook going into 2024, you're going to see abortion playing a major role, especially in those 18 plus districts for the House members where Republicans are currently sitting in those seats, but also in those battleground states. I'm going to be looking to see if those referenda are put on the ballot.
Does it matter, though? I mean, at a certain point, there's a question around the local or the sort of state elections versus the national ones, saying that they're very different in nature. Are you actually saying that this time is different and social issues could make the difference at a time where there are all these other issues, including economic ones?
I think voters are motivated with loss aversion. They don't want something taken away from them. And that's what we're seeing playing out in the abortion debate, right? And so if that is on the ballot, it's going to play a role until this issue is sort of settled law. And I don't think we're close to that yet. We're still debating this on the state level, and there are some who want to still debate it on a national level.
Jennifer, help our international audience with the evolution of Nikki Haley. It's a remarkable story. I mean, you go back to her childhood in South Carolina, absolutely remarkable story. How is the former governor evolving debate to debate?
So Nikki Haley, former governor of South Carolina, was a popular Republican figure back then. She played a role in the Trump administration as the UN ambassador and really took on an international role that she did quite well. And Republicans were very pleased with her. And she's been able to play into sort of the more moderate Republican, but also appeals to the conservative Republican, the Trump Republican. She hasn't offended in any way. And I think that her abilities on the debate stage are so strong that she is attracting a number of folks who maybe even are on the Trump train, but are interested in other candidates. And so I think her evolution is going to continue, and it'll be interesting going into next year what role she could play.
I mean, 11 years ago, in our John Micklethwaite interviewing the former Secretary of State in the last 24 hours, Haley's given a lot of credit for Hillary Clinton saying, we can do this. Are Republicans going to embrace her? Do you envision her wandering out on that stage at the GOP convention and being embraced by our modern Republican Party?
Yeah, I mean, the Republican Party is shifting, especially as it relates to international issues. I mean, we aren't necessarily the same. We're not seeing the same party as that we did 20 years ago. But I think it's an important voice. It's an important message. And it's a big umbrella, the Republican Party, as is the Democratic Party. And so there are a lot of voices there. And I certainly see her playing a major role in the convention.
When it comes to the economy, there was some discussion around how to get stable prices as well as spending. There seemed to be no appetite last night to cut some of the entitlements that are really sucking up a lot of the budget. There was a discussion, though, about the Federal Reserve. This is what Ron DeSantis had to say about the Fed. The Fed should focus on stable prices. They are not an economic central planner for the American people. So what is your sort of sense of what the economic policy here really is?
Well, I think there are a number of issues with talking about entitlements and entitlement cuts. Those are issues that you have a number of senators, bipartisan groups of senators who want to talk about, who are in a safer sort of position to start having those conversations. But I don't expect that to play a major role on the Republican debate stage. But that's a little unfortunate, right? Because these are the biggest fiscal issues facing our nation. As much as we're talking about some of the discretionary issues as we enter into the government funding fight for next week, the real game is entitlement and entitlement spending, because that makes up the large portion of where our trajectory of our debt, remains, right? So I think there will be a greater discussion, but it's probably going to be a fight in the general.
Jennifer, appreciate your perspective, the update from you and the team. Jennifer Flitton there of Invesco, looking out to the general next year. Let's go through the Goldman note together and picture this. Let's imagine Goldman's right for 2024. What does that mean for the politics? If the hard part, Tom, is over, if more disinflation is really in store over the next year, and if they're right, and they see only limited recession risk, and we continue to get an expansion through 2024.
Cardinal rule. Elections are not won or lost on fiscal policy. Maybe this will be different. By the time you get out to 2024, we're going to have the stimulus, which everybody, including an important essay in the FT today, everyone agrees the stimulus, whatever sets of it, was hugely successful. But you got to pay for it. And that could be the debate into next year.
You know, we don't have much time, but there's a lot of people that don't think it was hugely successful. And the Fed's still fighting it.
You look at 8% lift in real U.S. GDP. No other country's
I thought you were
close.
about to say 8% inflation.
No, 8% real GDP lift off the pandemic.
Bill Lee of the Milken Institute on all of this coming up next from New York. This is Bloomberg. Looking to extend the longest stretch of gains in 2 years on the S&P 500 to potentially make it day 9 on the S&P. 8-day winning streak so far. If it becomes day 9, Tom, as you indicated in our little conversation this morning before we came on air.
It's a little conversation.
It was a small one.
I get in at
the longest winning streak since 2004, potentially.
558. We have a little conversation. Russell 5000, whatever it is, RTYA, up 0.4% this morning. That's what Chris Marenghi was talking about. Even the small caps were out searching for growth this morning.
From the peak of the summer to the recent bottom in the last month or so, 18% move lower on the small caps. They've had a tough time. They're rebounded slowly. I want to pick up on something you said the last 5 minutes or so. I think you're right. The outperformance we've seen in the US economy relative to, say, Europe has been phenomenal.
Yeah.
And you can point to the fiscal package that has been delivered over the last 2-3 years. Without a doubt, the price we've had to pay for that arguably is higher inflation. The problem this administration has got, Tom, is how do they communicate to the electorate over the next 12 months that that was the right thing to do,
right,
that the growth we've got is a consequence of that, and the inflation that came about as a consequence was a price worth paying. That's going to be a difficult thing. That's going to be a difficult needle to thread.
That would force it over then from inflation, and let's say we get resilience, price leveling, even disinflation, it finds itself over on the balance sheet, the nation's balance sheet, in our public balance sheet. Ken Rogoff and Reinhardt were brilliant on this in their classic book. But the answer is there's the debt of the pandemic. There's the deficit of those are two different things. How are we going to fix that? And that's the presidential debate that America doesn't want to hear.
Which is why Abramowicz is going to be talking about auctions through the rest of this year.
Please, there's
debt.
Another one today,
30-year debt coming a little bit later, Bramo, right?
$24 billion coming, and this will be a test. Is it welcomed with the same kind of rally if it just doesn't fail? I mean, is that the threshold here that we're looking at?
Let's talk about the bond market. 2-year, 10-year, 30-year. 10-year yesterday, a break of 450. We've come down from north of 5% to south of 450 in just a few weeks. Right now, north of 450, 453. Yields up 3 or 4 basis points. On a 2-year, up a single basis point, 494.24. Interesting break in the commodity market yesterday as well to see Brent crude back below 80. Brent and WTI look a little something like this. Brent, very briefly there, in the 79.99 range of things. That's where we are currently, Bramo. And there's WTI crude, deep into the 70s, 75, 72.
The fact that the energy minister of Saudi Arabia pushed back against the declines and said that this was not driven by fundamentals or weak demand points out to me, watch this space. Does this mean they are not happy with prices where they are? I mean, to me, that was really notable, especially given some of the concerns people had over geopolitical risk. Well, their concern maybe is people are underappreciating how much demand there's out there.
So why were they cutting prices to Europe? Why did Aramco cut prices to Europe?
Well, right.
If demand is just a figment of our imagination.
You could argue that this is self-serving, trying to push up the prices. On the flip side, you have to wonder whether they're going to counteract this with further supply cuts, or at least prolong them.
Brent crude 80, up by 0.6% this morning. Under surveillance this morning, Israel intensifying ground operations as its army pushes deeper into Hamas strongholds in the north of Gaza. The Israeli military saying around 50,000 Palestinians fled to the south with limited pauses in the offensive to allow people to escape. Meanwhile, US forces firing upon a weapons depot in Syria used by Iran. At least Defense Secretary Lloyd Austin calling it a, quote, self-defense strike for attacks in Iraq and in Syria.
What I find most interesting about this is the imminency of some sort of expansion of this conflict seems to have been taken off the table in markets, right? There seems to be this complacency that this is going to be something that keeps going on, but that isn't necessarily likely to escalate because it hasn't so far. So are there still red lines? Are there things that we should be watching, especially if the U.S. is getting more active with respect to strikes in countries like Syria?
I get the idea that we're getting more active, and frankly, other countries are getting more active too. The Israeli military is surrounding Gaza City in some form. Are they listening to the politicians? At some point, military people have to do military. They don't listen to the politicians. And is that where we are in this incredibly painful, clumsy week.
Want to watch? We'll catch up with Anne-Marie in the next hour. Your next story, the frontrunner for the Republican Party nomination dominating last night's GOP debate in Miami. He wasn't in the room. Candidates vying to position themselves as an alternative to Donald Trump, spending significant time criticizing the former president.
I can talk about President Trump. I can tell you that I think he was the right president at the right time. I don't think he's the right president now.
Donald Trump's a lot different guy than he was in 2016. He owes it to you to be on this stage and explain why he should get another chance.
I think there's something deeper going on in the Republican Party here, and I am upset about what happened last night. We've become a party of losers at the end of the day. There's a cancer in the Republican establishment.
I'll say this about Donald Trump. Anybody who's going to be spending the next year and a half of their life focusing on keeping themselves out of jail and courtrooms cannot lead this party or this country, and it needs to be said plainly.
Lisa, Trump, meanwhile, skipping the debate to hold a rally just 10 miles away.
My favorite part is that Chris Christie's job is to be the bulldog on Trump, and everybody else has to kind of tiptoe around, not offending anybody, but basically trying to take jabs at him so that they can win against him. And that was clearly on display last night because they didn't really move much further. I mean, talking about sick of Republicans losing and blaming him was as far as they would go.
Get out the piece of paper. Greg Valliere does it this morning. I believe he's going to join us here. I mean, line up the losses, sort of losses, relative losses of the GOP over the recent number of years. And the answer is was mentioned in that debate. When, so much winning. Okay, when does the winning start for the GOP?
Well, let's save the politics for now.
Yeah.
And let's turn to this name. Check out Disney in the pre-market, rising this morning after posting a beat on profit and saying it will trim another $2 billion in expenses. The CEO, Bob Iger, has overseen cuts of more than $5.5 billion and eliminated 8,000 jobs this year, but said the latest budget cuts aren't expected to result in job losses, saying it will move the company from, quote, an era of fixing to an era of building. That stock up, Tom, by 4.5%.
So does that mean if you're doing a face plant, you do a Facebook? I mean, is that really what this is about? Cost-cutting work for Meta, Facebook? So it's cost-cutting going to work for Disney?
Let's just say it's a little bit different over at Disney for Bob Iger. Yeah, let's just say the stock performance is a little bit different as well this year, too.
Warner Brothers WBD, Warner Brothers Discovery, mental freeze, brain freeze there. Warner Brothers Discovery, I'm sorry, that was painful yesterday, below $10 a share.
Well, this is what a lot of investors wanted to see, including, I believe, Nelson Powell. So that stock is up this morning, Tom, by a little more than 4%.
My main story, as it's been for the last number of days, is watch China. There's any number of ways to watch China, and this morning it's on price. William Lee joins us. He's chief economist at Milken Institute, tours of duty with the International Monetary Fund. We're thrilled he could give us perspective here on the Pacific Rim. Bill Lee, I want you to explain to begin the importance of pork in the CPI index, and frankly, the importance of pork, pig, to the Chinese culture and diet. What's the so what of pork deflation?
Well, actually, the Chinese are telling us that the reason why they have the deflationary pressure they have is because pork is so important in the Chinese CPI, because it's such an important part of the diet and part of the consumption basket, that it really isn't that big a deal that they aren't really in a state of deflation, that the economy really is chugging along as they had hoped. That's a lot of malarkey, because after all, yes, as important as pork is, there's a lot of deflationary forces in the Chinese economy, which means that there's not enough demand. And why is that? Because the Chinese economy just is not given the right kind of policies. The Chinese have been trying to revive the economy by supply side measures. And we all know the problem is with demand, because people are afraid to spend because they don't have jobs, and their wealth is going down the toilet because of the property market. It really shows you a way of putting lipstick on a pig.
Will they export disinflation? Will they export outright deflation?
If pork really is the main cause of their deflation, it's not that big a deal for most of our CPI baskets, so they will not be exporting that deflation. But what we see is that the factory prices are really low, and they're coming out at the price of the factory gates have been going down for the last 13 months. That is one source of deflation for the rest of the world, because our imports are going to be cheaper and cheaper.
There's a question, though, of how many imports the U.S. is going to be doing and what the relationship really is going to be between the U.S. and China. How closely are you watching this dinner happening later this month with Xi Jinping and hundreds of business leaders in the United States?
This is really another attempt to try to attract foreign investors, because foreign companies are so important to China. Do you realize that foreign companies are only about 3% of all Chinese companies, but that 3% accounts for 10% of urban employment, 40% of China's trade, 16% of China's tax revenues. So foreign companies are incredibly important for the Chinese economy. And right now, they're trying to reverse the cycle of exodus, that everyone essentially is blowing out of China because there's no confidence that that is a profit center for companies going forward. And China's trying to say, hey, we have a friendly environment for you guys. Come on back. And that's a real hard task for them to do right now.
So, Bill, who do you think is courting who at this dinner? Do you think that it's the business executives in the U.S. courting Xi Jinping or the other way around?
A little of both, because the executives that are there, the Jamie Dimons and the Jane Frasers, we're here in China and we're here to assure you that we're here to stay. But the new companies that are trying to get into China are not the major companies that we all think about as multinational corporations, but instead they're the small little businesses that are thinking maybe China is still a good place to have low-cost labor. And I think they're finding out very quickly that the costs of doing business in China are much higher than they thought, because you can't get information. You can't get things done the way you do in the United States because of the security measures they put in place.
When we talk about the dampening effect of the Chinese economy on the global economy, there's a real question about what the tea leaves are. And people have pointed to the copper market. People have pointed to the oil market and prices there as a sign of just how much demand is falling off in China. Do you think that that's accurate? Do you disagree with the Saudi energy minister's proclamation in the past couple of hours that there is no demand problem and that, it's really just simply speculation?
Well, I think the real issue is where's the source of the demand problems. China is saying, well, we have a lot of domestic demand. It's really quite strong, and we're trying to revive even more of it. But it's really the lack of foreign orders, that the foreign companies just aren't here to produce, and we just can't produce for the rest of the world the way we used to. And they blame it on the anti-inflationary policies that the U.S. and Europe has put in place for dampening the prices there.
Billy, is austerity still comfortable? Europe and the United Kingdom seem to have a heritage of austerity. Does the leadership of China share the same tone of austerity?
Actually, the austerity they try to put in place is for this state and local governments who are running huge deficits and piling up lots and lots of local debt. They want them to control themselves, but they want the private citizen to spend like crazy because that's where there's a lack of demand. And every policy they put in place, whether it's lowering interest rates or trying to put liquidity in the banking system, goes into the private sector, and it gets all sopped up in savings. People just don't want to spend when they are afraid that they're going to be losing their jobs, when they're seeing salary cuts, and when their kids are unemployed. In a situation like that, you're not going to have the private sector helping you unless you restore some fundamental confidence that employment is here to stay and we're able to revive the economy. Right now, the Chinese have not done that.
Well, Bill, that's why we should finish with that elephant in the room, FDI. You saw the numbers in the last week. What can they do about that? Are we about to see a big charm offensive from Xi and others abroad?
You're going to see the charm offensive at the APEC meeting, but they're going to have to assure people that the fundamental changes are going to be put in place. The fundamental change is going to be that Xi no longer is going to mandate the centralization of everything. And right now, that's far from being on the horizon. Xi is done even more to centralize control.
That data turning negative recently. Bill, thank you, sir. Bill Lee of the Milken Institute. I think a lot of people just want a more predictable policy regime, Bramo, coming out of China, and they're trying to get their hands around where some of these things are going.
So at what point is Xi Jinping willing to compromise some of his ideological standpoints that have driven a lot of his policy stances and try to create some certainty to lure businesses back? I mean, you pointed to foreign direct investment. It went negative for the first time on record. This is a serious problem for them.
It's a big issue, Tom, which is why I think a lot of people are looking for that charm offensive in the coming weeks.
The charm offensive is there, but he's got some cushion because I see a lot of people still modeling out 5% real GDP, which is not 7%, but it gives him time to try his unique experiment here that Dr. Lee was talking about. I mean, 5%, he can get by.
Sure.
That's the basic idea.
Dollar China right now, 729.55. Check out shares of Disney, higher in the pre-market. We'll catch up with Geetha Raghunathan of Bloomberg Intelligence on their latest earnings. I wonder if Bob Iger is one of those CEOs meeting with the Chinese leader.
Oh, that would be interesting
in the coming week.
Especially given the bans.
We'll see. From New York City, this is Bloomberg.
on the call talked about going from fix to build. And I think that's kind of the headline. He stabilized the business and is now focused on reinvesting in the parks and in the studio, which has probably been neglected for the last few years. There's going to be consolidation in media for sure, especially amongst the streaming names. Don't know when that happens. It's probably over the next few years.
Good to catch up with Chris Marangi there, the co-chief investment officer over at Gabelli Funds. Check out shares of Disney this morning, up in the pre-market following earnings yesterday. The theme park business absolutely booming. The numbers growing 31%. The pressure's elsewhere, and we can talk about the pressure elsewhere in just a moment, which is why Bob Iger is cutting costs. Committed to cutting more than $5.5 billion already going into the print, and announcing an additional, looking for another $2 billion in savings, helping the name this morning, up 4%.
Where is that $2 billion going to come from? Because you pointed out it doesn't include additional job cuts. So I have to wonder, what else is going to be sort of sold or chopped off? When you look at the 4 pillars, they did not include linear television in any way, shape, or form, or television shows. I start to wonder what's going to happen with some of those legacy platforms.
He's almost encouraged the conversation around ABC and ESPN earlier this year, Tom. Open the door to a sale of some of those units.
To sell to who? Help me. Who are they going to sell ABC to?
ABC, I don't know. Dan Ives of Wedbush offered up Apple buying ESPN once again.
Or a minority interest. I get the minority interest thing.
But you're right to point out the environment now for media is very different to the one we were in 2-3 years ago. Selling those units now, those divisions, Tom, that little bit more harder for Bob Iger.
You guys live this far more than I do. I mean, what are you watching at home? What of those
Bloomberg
silly
surveillance.
icons? Bloomberg surveillance, right answer.
Reruns.
But it's just great, and the forward view is stunning. When you look at the icons that are out there, which ones do you click on?
Well, the kids click on Netflix, and I'm the person who just looks for specific movies and tries to pick out which particular streaming network has it.
Besides Formula One,
Peacock for Premier League football, Paramount for the Champions League and for Serie A.
So what are you spending
Italian
per
football,
month?
ESPN, because it carries Formula One, it's a part of Hulu. What are we spending a month right now on apps?
have you ever had
streaming?
it up? It must be nuts.
$80 a
Well,
month.
Hulu's close to like $90 a month now, once you have everything sort of baked in. But that includes Disney, and that includes the likes of ESPN as well. If you throw it all together, it must be pushing $150 a month. Easy.
Yeah.
That's before you're paying for broadband. We've said this a million times. Once you add it all up again, the cable bundle's back. You're not saving any money, Tom. You're not saving money at all. In fact, I'd say for the consumer at the moment, it's probably more expensive.
Right.
Not less.
Culture with Bloomberg Surveillance. Scarlet Fu consulting in on this morning. What you need to know is it's April of 2011. There was a show then, Game of Thrones. Winter is Coming was the first episode. And that's where we are right now with the screaming success in days of Blue Eye Samurai on Netflix. I'm watching it. I can't say enough about the shocking beauty of it. It is overwhelming how it is game-changing for streaming. Geetha Raghunathan knows this. She's U.S. media analyst at Bloomberg Intelligence. And I would suggest Disney knows this as well. Geetha, boy, does Disney need a Blue Eye Samurai.
They certainly do. And that's one thing, Tom, that Bob Iger really emphasized yesterday. He said he is looking to reinvent the studio. Those are the words he used, and he really emphasized quality over quantity. So you spoke about how spectacular Blue-Eyed Samurai is. That's exactly what Disney is going to go after. They talked about, the studio having some kind of franchise fatigue, too many TV series created for the streaming service. So they're really kind of streaming down or cutting down, I would say, paring down on a lot of the content costs. Lisa was talking about where those savings are going to come from. A lot of that is them just really cutting down on content costs. So they took down content costs from $30 billion to $27 billion for fiscal 2023. They're taking that down further to $25 billion. And that is where you get that big free cash flow number for them as well. $8 billion is what they're projecting for 2024, a 60% increase from this year.
Now, I get it, it's anime, it's animation, but the basic idea is Blue-Eyed Samurai is as non-diversity as we could get in 2023. Is Disney moving on from the tone and temperament of the last 3 or 4 years? Is Iger going back to something or new to something different?
I think it's a combination of everything, Tom, because he needs to go back to the drawing board. He knows that there hasn't really been a new Star Wars or a Lucasfilm movie since 2019. Obviously, the Marvels is in its next kind of iteration, if you will. So there's a lot of things that he needs to do. But the biggest thing I think for them, for the Disney studio, and this has kind of been a little bit shocking. And you bring up animation, and that's a really good point, because a lot of their recent animated movies have actually not performed as well as some of us would have expected. And Pixar has kind of been has had kind of this string of misfires, if you will. And the studio that is really kind of giving them a run for the money is Universal with Illumination. We had you have Super Mario, you had Minions, all of these animated movies from Universal doing really, really well. So Disney obviously going back to the drawing board and kind of doing a lot of rethinking and as Bob Iger said, reinventing the whole franchise.
If Bob Iger was the movie, is this Nightmare the sequel?
That's a great...
It's not going well, Geetha, is it?
Well, I mean, he tried his best. And if there is, any person for the job, any person who can actually fix and rebuild Disney, I think it definitely is Bob Iger. And he, kind of delivered signature Bob Iger kind of news yesterday. Lots of good news, lots of nuggets of, good, optimistic news for investors to kind of hang on to. Obviously, there is a lot of work that remains to be done. But we do know that there are some real growth drivers for Disney, whether it's the parks business, that is 70% of Disney's operating income, throwing out about $10 billion in operating profits and cash flow. So that definitely is a huge growth pillar for the company. And then, of course, is streaming and how they're kind of going to manage that whole business. We know that they're in the process of consolidating Hulu. The big question is how they're going to manage the ESPN transition and, whether that Disney bundle, the streaming bundle, really becomes the competitor, a true competitor to Netflix.
Is rebuilding a euphemism for shutting it down in terms of streamlining certain businesses and getting off selling the rest of it?
Yeah, so he seemed to actually walk back a little bit of, the linear TV commentary. I know we've talked a lot about ABC and some of the other networks kind of being up for sale. But he also did say that there is a huge cost opportunity when it comes to, those linear networks. And so they've actually, the Charter deal that they recently inked was kind of a catalyst for them shutting down a lot of, the smaller networks that they don't consider core. And I think that's what they're going to do. They are definitely going to streamline the business. You're absolutely right, Lisa. I'm not sure when or how the sale is necessarily going to happen, but Iger seemed to suggest that even if a sale doesn't happen right away, there are a lot of synergies and there are a lot of cost efficiencies that they can hopefully extract over the next few months.
Geetha, this one's a tough one to answer, but explore the question with us if you can. Tom mentioned who's buying. If they're selling, who's buying? Where do the buyers come from?
So it could be private equity. I mean, we know there has been interest from certain parties. Byron Allen was one who kind of made a bid for the ABC and some of the networks. Again, private equity always is interested in, the TV assets because they do. Yes, it is an industry that is in secular decline, but at the end of the day, it does throw out a lot of cash, and that is valuable. So, yeah, again, it's a little bit of a wait and watch. I mean, there has been some chatter about whether the leagues would be interested in kind of going and getting a broadcast asset. I mean, broadcast assets like ABC don't come up for sale very often. So, maybe it is something that the league can potentially consider for reach.
Interesting. Geetha, appreciate the update. You're valuable. We appreciate your time. Geetha Raghunathan there of Bloomberg Intelligence. We'll catch up with Geetha again around the opening bell a little bit later this morning. Shares of Disney in a pre-market up there by a little more than 4%. What are we watching now then, Tom? What's it called?
Blue-Eyed Samurai.
Blue-Eyed Samurai.
It's great. I just learned this. We're doing while Bram was going on. I'm looking at research of that, trying to figure out what the kids' summer camp looks like. And in the lead character's voice, Kenneth Branagh is in this. Is the voice. Kenneth Branagh is the bad guy.
Very cool. Him.
And the lead, and I don't know her, Maya Erskine is Peter Erskine's daughter, the great jazz drummer of America. And it's just. I really can't say enough about this. It's really violent, first of all. Let me make this clear. As I mentioned to Geetha, and the whole question of the aura of diversity, this is as anti-modern woke as you can get. The only reason they can pull this off is animation.
Well, which raises this question, who's going to be animating it? And that's the reason why I thought Jeff Katzenberg's comment overnight was really interesting.
Huge respect.
Talking about how it's going to be by a magnitude of 10 cheaper to animate things with artificial intelligence. Right. I wonder if the timing of the actors' strike ending around now has anything to do with this.
I got an email from a fan today from northeastern England, Julie from York. And Julie said to me, what is it? And I said, you got to sell emotion. And that's a difference between Netflix and Disney. Netflix is selling emotion.
You've got to get rid of that woke.
It's good. It's good. See ya.
The stock market rallied because the bond market rallied. And that's just not typical.
Growth keeps surprising on the upside, and that might continue.
Markets are a little bit more volatile right now than the underlying economy is.
It's going to be slower, but I don't think we're about to go into global recession.
It always looks like a soft landing just before a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The longest winning streak in 2 years on the S&P 500 could well be longer after today. From New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market this morning just about positive by almost 0.1% on the S&P. 8 days of gains could become day 9. We make it day 9 on the S&P 500. That's the longest daily winning streak, TK, back to 2004.
It is. We had Chris Morangi in the last hour. We're going to start strong with Julian Emanuel, and this is about the shock, not so much of shorts. Yeah, the shorts are wrong, and I get that. Maybe they'll have their day here. But it's about people, millions of people, John, who are tentative about equities. They're just collegially afraid to be there in the confidence of price to move up right now. That's something they've got to reassess. And you mentioned the Goldman Sachs note.
Sure.
Even there, everybody's reassessing this morning.
Let's go through the Goldman Sachs note, the outlook for 2024 from Jan Hatzius and the team. The hard part is over, apparently. Lisa, it gets easier from here. More disinflation in store over the next year. As for recession risk, listen to this line. We see only limited recession risk going into 2024. A very constructive outlook from the team at Goldman.
The warm embrace of the soft landing, you could just feel it right now
the
in
warm
markets.
Hug of Jan Hatzius.
The warm hug of Jan Hatzius. The warm hug of the optimism that's coming into the equity markets. The warm hug of Tom Keene's hand as he goes down like this every time I speak. There is a question here about whether it is nice until it's not, right? And whether we're ignoring some of the tea leaves.
Ramos like this.
This is my Jane Fonda Atlanta Braves. Okay. Gurgieva's like...
Anyway, are we really there, or is this something that's the beginning to something?
I don't think it's a soft landing because you have disinflation. Ed Hyman nailed this at Evercore ISI by saying we are going to get a disinflationary tendency, and yet Ed Yardeni would say, okay, and then you get a muddling along economy. I'm not sure for a lot of Americans it's a soft landing. It's price decline, less nominal GDP, and they don't own 10,000 shares of name the stock.
Let's not complicate things. It's an equity rally inspired by a monster bond market move in reverse. 50 basis points from peak to trough in the last couple of weeks. We broke 450 yesterday on a 10-year. And you'll get the people who push back and they'll say the following. It sounds something like this. This will sound familiar. It'll look like a soft landing until it doesn't. And it's the same in the bond market, Tom. At some point, yields go low enough that you start to say, oh, what's happening with growth? Same thing with crude. You start to break 80, you get deeper into the 70s, lower into the 70s, you start to say, oh, what's happening with growth? And I wonder whether we start to see that inflection point where we break down that correlation between bonds and equities. Instead of rallying together, they rally in different ways.
I'm loving the triple leveraged all cash bond portfolio. You know that's the Austrian 100-year piece. And I'm up 18% in that puppy right now. That doesn't note that I was down 70% from when we loaded the boat.
That's a small detail.
Small detail. We're up 17%.
Nice bounce there. Nice bounce. Picking up some duration, TK.
Yeah,
sure. Equities right now on the S&P, just about positive by 0.1%. If you are just joining us, some data, some auctions, a little bit of Fed speak. Enough to keep you watching this morning, no doubt. Yields up by 3 basis points, a 10-year, 452.74. Bramo, take it away. Give us the day ahead.
I'm just going to give you the excitement. We've got a little bit of data. We've got economic data. Hold on. Just wait for that excitement. 8:30 a.m., we get initial jobless claims. It actually is the first meaningful data that we've gotten all week because it's been such a quiet week. What I think is interesting, we always show the unemployment rate on this chart that's completely distorted by the pandemic. And so you lose sight of what's happened over the past 6 months. And what's happened is a slow creep up by a 0.5 percentage point in the unemployment rate. This is one to watch to see whether the soft landing is premature. 1 p.m. This one's for you, Tom. U.S. Treasury is selling $24 billion of 30-year notes. If it tracks what we saw yesterday, if it doesn't fail, it will be a roaring success. It could fuel another leg of a rally.
What's the distinction? I busted chops, folks. Abramow's like the adult in the room on this. What's the distinction between a 10-year enthusiasm and the 30-year enthusiasm?
There has been more tepid demand for 30-year notes, right? Both of them have been messy over the past
foreigners and
weeks.
domestic.
Foreign and domestic, but there is perhaps a little more concern over the longer term, especially with the fiscal. We shall see. There was actually a report saying Japanese investors actually piling into U.S. bonds. So we'll see where the demand comes from. 2 p.m. Fed Chair Jay Powell also planning to speak at an IMF panel that includes Geeta Gopinath of the IMF, Harvard's Ken Rogoff, who is the only person that Tom will be listening for, the Bank of Israel governor, and it will be moderated by
you offend
the
Dr.
IMF's
Gopinath like
chief economist.
Okay,
I'll
I
leave
look
it
forward
there.
to that. Isn't it bizarre that we think the 30-year auction will go better with a yield of 4.66 than it would with a yield of 5%? Does that make sense to you?
The only thing that makes sense is the number of people who came on the show who were bullish on bonds, who were not buying because they were concerned about the incredible volatility and the lack of understanding of what was behind it. Maybe they will come back when there's stability, even if it's at a lower yield.
Do they got that understanding now?
I don't know.
I'd love to
That's
know.
a great question. Let's get Bob Michael on the phone.
Gillian Emanuel joins us around the table, Chief Equity Strategist over at Evercore our side. Gillian, good morning to you.
Good morning.
Have you been participating in this wonderful, beautiful thing that is an 8-day winning streak?
Yeah, we have. Several weeks ago, we just felt that when you backed off of that 5% yield, and I know we've been talking about it, but it is the fact that in this world now, for the last year and a half, where stocks and bonds have been positive correlated, if bond yields go down, stocks go up. And backing off of 5% was huge for the psychology. And now we've got this unexpected oil price plunge, which is even bigger for shareholders.
I'm with you. Those 2 points yesterday stood out for me. Break of 450 on a 10-year, break of 80 on Brent crude. At what point do these correlations start to break the other way? What brings about that change?
Well, we are watching that very closely. And guess what? The high-frequency data is really important because that chart you were talking about a few moments ago with the unemployment rate rising from 3.4 to 3.9, in the past, when that starts to happen, it tends to snowball. But where we're going to get the initial read on that is that 830 jobless claims number. Starts edging over 250,000. We get a little bit cautious. 300,000 is where we know the economy is going to turn down.
I'm supposed to fold in now a question on Ed Hyman's Hicksian ISLM theory and his disinflation theory into your stock babble. Forget about it. I love the single sentence you have, which pushes against all that malarkey by saying price is paramount right now. When you talk to Ed Hyman, how does he respond to you telling him your economics doesn't matter, price is paramount?
I'll tell you how. 5 weeks ago, Ed Hyman started putting out almost daily the fact that gasoline prices started falling. As the conflict was erupting, you already had the turn in gasoline prices completely, devoid of real sort of sense.
How can we have prosperity with Hyman's disinflationary tendency or outright deflation in China?
Look, if you look at the last 15 years, you've had episodic times of that from, again, obviously, the financial crisis was one of those times. But ultimately, what it comes back to, again, for equity investors, for bond investors, first of all, the whole idea of getting a real return on money in this world now is actually a positive for financial assets. It's a positive for capital allocation. And long-term, it's a positive for growth. And that's part of the equity investing mindset.
Do you need a long-term view right now, or do you just trade the short term?
It's really difficult to have a long-term view because of what we're talking about, the inflection in the economy potentially happening. But if you take the super long-term view, is that even if you get the recession that Ed's thinking we're going to get, that it's going to be mild in 2024, what you're left with is a labor market that has rebalanced. What you're left with is, again, a real cost of money, better capital allocation. And frankly, we've talked about this before. You have new technological developments like generative AI that is going to improve the productivity of corporate America over the long term.
One of the main frustrations of this year was that pretty much everything everyone said at the beginning of the year has proven to be wrong, including that this would be the year that tech stocks would fade more meaningfully, and you'd start to see a broadening out in the rally. Energy stocks would start to be the true leaders. You just actually moved away from an overweight in energy and are talking more about generative AI. It seems like the theme just keeps on being that the leaders will keep leading and everything else will just have to figure out where they fit in.
Well, look, again, the recession will probably, to the extent that it does arrive in the next 12 months or so, rationalize some of this. But ultimately, what it's going to do, and look, part of the consternation on equity investors' minds is the fact that the Russell 2000 is making new lows. Ultimately, you're going to get to a point where there will be an attractive price for the other 493 stocks away from the Magnificent Seven, and you will get to an earnings reset. We think that's part of next year's narrative.
This is the difficult question I think people have got to confront at the moment. Do I want to buy the recovery to the recession I've not had yet? Given the damage we've seen in the small caps, you can pick up various places that back up the consumer discretionary story, airlines, for instance, which have come way off the peak back in the summer. Do I want to start picking up the pieces going into what could be a slowdown next year?
We think you need to be balanced. It's one of those things where, again, given the lack of visibility into next year, what we always say, we've had a very nice run in recent weeks. And if you go back over the last year, it's been a very nice run off the October lows. You need to be comfortable with the fact that if the market comes in 10 or 15%, which it does in any typical year, as it did several weeks ago, that you're a buyer of the dips. And whatever that asset allocation is to you, that's the kind of discipline you need to employ.
Goldman speak to this as well. We've gone through their note this morning a few times. It's worth doing it again. The hard part's over. More disinflation is in store over the next year. On growth, they see limited risk of a recession. And they say this on central bank policy. I think this is a really, really interesting point. An increased willingness of central banks to deliver insurance cuts if growth slows. Earlier this week, Ben Lader on this program of eToro was saying the Fed put was back. Lisa and I looked at each other and almost spat out our water. The Fed put is back? Insurance cuts if growth slows? Is the old Fed story returning?
No.
Why are they wrong?
No. Look, because there's an assumption that there's a reflex reaction to a minus, GDP quarter. Thankfully, we didn't see it in 2022 when we had that, because if you had interrupted the rate hiking program, you wouldn't have gotten to where you are. And you can argue both sides of this case. But frankly, for us, there is a commitment, given the fact that core PCE is still solidly with a 3 handle, that you just can't go down that road unless it really looks like there's a severe economic downturn. And we still think there's enough savings left over, so that won't be the case.
Julian, awesome as always. Julian Emanuel of Evercore. If you are just joining us, welcome to the program. Your price action, the scores this morning look like this on the S&P 500. We're positive by 0.1%. Yields are a little bit higher by 3 basis points, 452.94. Coming up in the next hour, Tom, we'll continue the conversation. Cameron Dawson of New Edge Wealth.
Futures are 4,400. Stolfus can pack it up and go home for the year. I mean, some of the bulls out there, they're hitting their targets right now.
We spoke to Gabelli Funds last hour.
Yeah.
I asked him about Meta this year. Facebook up 165.73% year to date.
And I just looked at
sticking with the name, Tom, into next year.
I saw this in the zeitgeist. I'm so sorry I can't remember who to quote. 70% of stocks don't participate in a bull market. I just looked at 3M, which is a problem child from Minneapolis. This is the Minnesota Manufacturing and Mining Company. Post-it notes.
Post-it notes.
And before that, a thing called Scotch Tape. Open Me First. And the answer is 3M's done nothing. It's up 6% off the bottom, where some of these other companies I mentioned at the top of the show, Microdog is up 17% off the bottom.
You were looking at Kimberly-Clark as well, weren't you?
Kimberly-Clark, I'm looking at another
toilet paper.
I don't know what to do with it with single digit. I mean, help us here, Julian, quick. Single digit revenue growth. I'm popping 12, 15, 18% EBITDA, and nobody cares. Nobody wants these kind of stocks.
The market will embrace that in 2024.
They're going to see a deepening rotation.
Yes.
See that?
It's beautiful.
It's just such
just
a poetry.
Short. He knows there's a commercial break. Julian, thank you. It's good to see you. Greg Valliere, AGF Investments on politics coming up next. From New York City, equity's doing better than okay over the last week. We're positive this morning. From New York, good morning.
can talk about President Trump. I can tell you that I think he was the right president at the right time. I don't think he's the right president now.
Donald Trump's a lot different guy than he was in 2016. He owes it to you to be on this stage and explain why he should get another chance.
I think there's something deeper going on in the Republican Party here, and I am upset about what happened last night. We've become a party of losers at the end of the day. There's a cancer in the Republican establishment.
I'll say this about Donald Trump. Anybody who's going to be spending the next year and a half of their life focusing on keeping themselves out of jail and courtrooms cannot lead this party or this country, and it needs to be said plainly.
GOP presidential candidates offering a few opinions on President Trump and the state of the Republican Party last night on NBC's presidential debates. From New York City, your price action this morning looks like this: extending gains on the S&P 500, the longest streak of gains going back 2 years on the S&P. 8 days of gains. 8-day winning streak on the S&P, make it day 9 on the Nasdaq at a close yesterday. This Thursday, equities higher by 0.1% on the S&P. Yields up as well by 4 basis points, 453 after closing below 450 on a 10-year in yesterday's session. For crude, 75.70 on WTI. For Brent, 79.98. Brent crude, Bramo, a break of 80 this morning.
And the why, I think, is important. Is this because of softer demand? Does this indicate a cooling in the global economy? Or is this something else, the speculation that the Saudi energy minister was talking about? You pushed back a little bit, saying that, well, they are cutting prices to Europe, so there seems to be something bigger going on. If that's the case, is this does this coincide with the idea of a soft landing?
Does it, Tom? Crude lower? Yields lower?
I think
both of those things, that's what people are hoping for.
That's what they're hoping for. Absolutely. There's no question about that. Is it a soft landing? I don't really want to frame that, because I think a soft landing speaks to a buoyant real GDP. And when Nick Brennenbrook's given me a global GDP statistic of 2.4%, with China popping 5%, all my radar's up about the soft part of soft landing.
Peter Chi of Academy Securities. Great conversation earlier this week. Fantastic. If you missed that, by the way, check it out. Just fantastic from Pete, as always. It's a moment, not a destination. It looks like one now, so buy it. It's essentially what he's saying. For the next 2 to 3 weeks. He thinks there's a window here, but ultimately, Tom, beyond then, no idea.
I'm going to go to the
I don't think anyone's got any idea.
The Goldman Sachs note today framing out, most of the economists of the quality of Hatsias are just trying to get out to Q1 2024. Who's framing the summer of 2024? No one. There's not a single American framing the summer of 2024.
Well, that's going to be what a lot of people on Wall Street do over the next couple of weeks, Tom. It is outlook season. It's upon us.
It's outlook season, and also the political outlook as well. Joining us now to brief off the GOP debate last night, Gregory Vallier, Chief U.S. Policy Strategist at AGF Investments. Greg, I stood on the floor of the GOP convention of 2004, and it was a different Republican Party. George Bush Jr. wanted a more hopeful America. What's going to be that slogan this summer for the Republicans?
Well, I think they'll emphasize the economy. They'll state that Biden has not done a good job. Frankly, I would disagree, but I think that they'll make it more about the economy than anything else. The really intriguing issues are abortion, number one, and number two, how much more involved are we going to get in Ukraine and Israel?
What about the idea that they're losing elections, not doing as well in certain elections? It can be the mix of that we just saw. It can be from a year ago, November, et cetera. How do they start winning again?
Well, I don't think you talk like Ramaswamy. I think he talked himself off the boat last night. I don't see much of a future for him. Probably not much of a future for Tim Scott. So it's dwindling. You've really only got 3 challengers. DeSantis, who was okay last night, but made a strategic error. He didn't mention the governor of Iowa had endorsed him. I can't believe he didn't talk about that. And then you've got Nikki Haley, who'll stick around for a while, maybe Chris Christie, but we'll begin 2024, I think, with just 2 challengers to Trump. And that would be DeSantis and Haley.
Do you think either of them have a chance of taking Trump off the ticket?
That who would?
Either of them.
Oh, no, not at all. I mean, Trump would have to do something really egregious, and he's pretty much filled the role on that for the last couple of years. So, no, I don't see anything, barring a health issue, that will keep Trump from being the nominee.
Meanwhile, President Biden is going to meet with the UAW leader today, and there's a real question of what he can do to shore up the image of Bidenomics, of what's happened in the economy, which some people are saying on paper doesn't look so bad, yet in practice has a lot of people feeling like they want something different.
Well, it's a good question, Lisa. I'm told that within the White House, Biden is angry. He feels he's done a pretty good job in the economy and gets no credit. So he's going to hit the road and try to make his case. The problem is an awful lot of Americans fear that we're not out of the woods and there's still more inflation threats, food, gasoline. Right. Still to come.
Greg, Valier 101, folks, this is a great course to take in politics. You get it off the back of a matchbook. You can take Valier 101. Greg, your Valier 101 is fiscal issues at the day of the election don't matter. Are you telling me the debt and the deficit don't matter the first Tuesday of November?
Well, when you look at net interest costs, you look at borrowing costs, this is becoming a major crisis for the bond market. And there's no mood in Congress whatsoever to dramatically cut the deficit. However, I think that once we get through Labor Day of this coming year, this stuff will be irrelevant. I think attitudes harden during the summer. Yep. If Trump is well ahead, he could pull this out. But I have a feeling that Biden will come back. I have a feeling that the Democrats all of a sudden are motivated because of what happened in Kentucky.
Is the path of least resistance for the former president another tax cut?
That's going to be on the agenda. You're absolutely right, Tom. And I think with the Senate probably flipping and the House probably flipping, you're going to have a climate that will be ripe for a huge argument on whether we extend the Trump tax cuts. I think we will. I think Trump will talk about tax cutting, even though the deficit is enormous.
Greg, I have to wonder whether this time is different. A lot of people who come on the show will say dysfunction in Washington, D.C. is the reason why yields have been flipping and flopping and going all over the place. And then they talk about a potential government shutdown and say markets won't care. Have we reached the point where market dysfunction is going to result from political dysfunction in D.C. in a more material way?
Well, we're going to see probably another alleged crisis on November 17th if there's no budget. I don't think the markets will be all that concerned about it. I do worry about the credit agencies, Fitch, S&P, downgrading U.S. debt, not just because of the size of our debt, but because things are so dysfunctional in getting a budget.
Great to catch up, Greg. Appreciate your input. Greg Valier of AGF Investments going into next year. My favorite stat right now, politicians and the distortion of reality between what they want to talk about and don't want to talk about. America right now is producing 13.2 million barrels of oil every day. And if you were to ask, I think, the average person on the street, Tom, and you can do this one day, go around with a camera and a microphone,
sure,
go to different states and ask them what their political
Madison
affiliation
Avenue
is.
In the 60s.
Once you've asked them what their political affiliation is, ask them how much crude they think we're producing in America right now. We're producing more now than we were in the Trump years, and see what they say. Mm-hmm. And I don't think they're going to say what you think they should say, which is ultimately, we produce more now than we did then. The issue is that the Democrats don't want to talk about it either, Bramo. The White House doesn't want to talk about that stat. They don't want to talk about that data point because they don't want to upset a fringe of the party that would be upset that America is producing 13.2 million barrels of oil a day.
It's a fascinating point because on the Republican side, they don't want to talk about that because that actually feeds into this idea of, well, let's explore what the United States has to offer. Let's drill. And President Biden doesn't want to talk about that because it goes against some of the clean energy initiatives that he himself has put out there. On the Republican side, I would argue nobody really wants to talk about abortion. That's sort of the conversation over there because on one hand, they're, losing on that issue and they recognize that. On the other hand, they have to cater to certain constituencies. So at what point do you just cater to a general election rather than constituencies?
Into our coverage of the conventions and the political stream and all that, what it really comes down to is if you look at this, is it going to be an election about culture wars or is it going to be an election about economics? The economy's stupid. I'm not so sure this time around.
The conversation continues. Megan Robson of BNP Paribas. We'll find some time to talk about crude a little bit later. From New York City, this is Bloomberg. Keep it together, Bramo. Equities on the S&P 500, positive here. Positive over the last week or so. On the S&P, we're up by 0.1% over the last week. 8-day winning streak on the S&P 500. Day 9 on the Nasdaq in yesterday's session. We're pulling back a little bit on Nasdaq futures. We're down 0.1%. The Russell looking to bounce, been really beaten up over the last few months. Off the summer highs, down about 18%, just a bounce off the low over the last couple of weeks. We're up here by 0.5%. In the bond market, 2-year, 10-year, 30-year, 10-year yield, a break of 450 in yesterday's session. Yields up this morning by 5 basis points, 454, up 7 basis points on a 30-year, 468. Bramo, some issuance coming again later this afternoon.
Yeah, we're going to be getting $24 billion of 30-year bonds. Is this the stability that people have been looking for? You asked this question earlier. Have we seen enough to show that the technicals are giving people confidence that these valuations, these levels are real? I don't know the answer. I don't know what people need to get that conviction, but I think it's the right question to be asking.
Still getting big swings in bonds. We'll talk to Mohammed El-Erian about this a little bit later. He's going to join us at 9 Eastern time on Bloomberg TV, so look out for that. Let's finish on crude. We mentioned crude production in America, 13.2 million barrels a day. No doubt helping out crude, Bramo, with crude back in the 70s, 75, 79, positive by 0.6%. Should we focus on supply or should we focus on demand?
Certainly, people have been more focused on demand over the past couple of weeks as the possible reason for the declines. I don't know whether that's the right place to look. This is one of the most confusing signals to get. A lot of people are saying that maybe this signals a bit of the soft landing because at least the demand is cooling but not dropping off a cliff. We shall see. This is actually one of the most important places to watch.
Those 2 points, TK, Brent breaking 80 in the last 24 hours briefly. The 10-year breaking 450 briefly. Those 2 points stand out across the screen for me this morning and yesterday.
I take it global, as we talked about all morning. You've got a global disinflation, outright deflation on pork in China. And where I'd really go, John, for this in terms of a global sense and how you get to these low GDP numbers is Germany. I don't think we've talked enough about the new Germany, which is not the stereotype we hold in our minds, is a manufacturing juggernaut. They've got serious disinflationary and growth tendencies.
They've got to see some real changes there. They need a new growth model.
I mean,
that's
we've underplayed it, and I just think that's off the mark a little bit. Again, look at the bid on the screen here. I got Russell, what is it, 2,000, 5,000? I can't keep track, up 0.5%.
The small caps are up this morning, Tom. The S&P's high too. That's wonderful.
It's a data check.
Russell 2000 futures, TK. It's written on the screen there, up by 0.5%.
It is written.
Under surveillance this morning. Israel's military saying it killed the head of a key Hamas missile unit in a targeted airstrike. About 50,000 Palestinians have fled to southern Gaza, according to Israel, as the army pushes deeper into Hamas strongholds. This as US warplanes strike a facility in Syria used by Iran. Defense Secretary Lloyd Austin saying it was in retaliation, Lisa, to attacks on American forces in the area.
I was struck last night at the Republican debate at the tone about Iran. They really went directly after Iran, all of the Republican candidates. And regardless of the criticism that President Biden has come under for the approach for the U.S. government, the Republicans, the vision that they offered was even more so on the other side. So that seemed to be the poles of where this is evolving.
I wonder where that is 6 months from now, 8 months from now, with Iran. Whatever happens within this terrible war in the Eastern Mediterranean, I just really, really wonder how we fit into a new diplomacy with Iran. That's under huge debate among people in international relations.
These things, Tom, that you can say when you're out of power and not in power.
Exactly. Yeah, that's huge.
If you take a Nikki Haley off the debate stage, what does Nikki Haley stand like in the White House?
Secretary of State
confronting
Haley,
this situation?
or,
precisely.
Yeah.
I don't know the answer to that, but you'd have to imagine that maybe they temper some of the message. What are you up to?
The surveillance fly is flying around the studio.
It's been doing that. That fly's been going around for the last 2 weeks.
Yeah, it's got a bow tie.
Let's get to the next story. The fly's got a bow tie.
Yeah.
Okay. Hollywood studios and actors ending their strike, tentatively agreeing to a new contract. The union saying it negotiated a contract of over $1 billion that includes unprecedented restrictions on the use of AI to recreate an actor's likeness. I love this. We're going to have to do this, guys. The SAG-AFTRA's National Board will review the deal tomorrow. Is that the future, Bramo? Going to have to tell our bosses no AI impersonations of anything we do.
Or at least we need to get royalties from those AI impersonations.
There we go.
So,
just sit at home and type the script.
Exactly. And they can speak it for us. To me, I wonder how much they came to a deal after 118 days because of the pressures that they're seeing with the cost cuts, the likes of Disney. They're going to be talking about how to streamline some of the production costs. Well, if they're going to get a piece of it before AI just takes over outright, they might as well get it now.
The damage is done, isn't it, Tom? The movie slate has been pushed out 2,
that
3,
always
4,
happens.
5 years.
Yeah, I'll go with that. But my answer here is the customer is going to decide. It's the customer that decided they wanted to watch Game of Thrones, they want to watch Netflix. Clearly, the customers decided they want to watch YouTube. Where does the actors and actresses come into YouTube participation? I don't get it. I just don't. I'm not sure I know where the future is. I'm certain this morning at Warner Brothers Discovery, they don't know where the future is either.
You're long Netflix this morning, right?
I'm way long Netflix, yeah.
Blue-Eyed Samurai.
Blue-Eyed Samurai is the new Game of Thrones.
I'll check that out.
Jaw-dropping.
Okay, I'll check that out.
It is gorgeous.
This weekend. Let's finish on these comments. Citadel founder Ken Griffin warning that the higher baseline inflation may last for decades. Griffin sitting down with Bloomberg's Eric Schatzker at the Bloomberg New Economy Forum.
There's many trends at play right now that are pushing us towards deglobalization. And with that is almost certainly a trend towards higher baseline inflation.
For over what period?
It could be for decades.
It could be for decades. Tom, that is going against the grain this morning, for sure. Because after you get a 50 basis point move on treasuries, all of a sudden the narrative flips. Narrative flips, Bram, almost instantly.
You can't even do this with a straight
We're
face.
going back to the pre-pandemic world, low and stable inflation.
2%.
Jay Poloski at TPW was really going in that direction yesterday. Yeah, Ben Laidler earlier this week. TK, are we going back to that, or is Ken Griffin going to be right?
Ken, I don't know. I got Ken Rogoff. Speaking of another Ken Rogoff's going to speak today.
So
with
excited
Chairman
about
Powell.
Ken Rogoff.
And I'm going to listen to Ken Rogoff about inflationary dynamics.
I like Ken Rogoff too, but I've never seen someone so excited about
I'm excited
Rogoff
about
on
it in
stage.
terms of macroeconomics. What I want to talk to Ken Griffith about is the incredible concentration of the market in what he invented, which is this minuscule, hugely profitable trading method that they use in the modern day. I mean, Ken Griffith's not making eights off Anaconda Copper.
So you want a conversation with Ken about Citadel the machine?
I don't think people know what Ken invented. I don't think he's gotten credit for
his
it.
thoughts on macro. Or you want both?
I'd like his thoughts. I'd like both.
A bit of
I
both.
think he's
Okay.
got him some slack. I'd like both. But I find it absolutely stunning. This, as we heard from Julian Emanuel, the market we are in is original, and I certainly do. I'd love to know what Ken thinks about
This rally's original. Over the last couple of years, 8-day winning streak on the S&P, Tom, could become day 9 a little bit later.
Day 9 for commercial real estate is it's here. That's all you need to know. Cranes has done a great job of this in New York, and the victim du jour is a lovely old building in Brooklyn on J Street, which I was reading about this morning. Megan Robson knows this cold, the head of U.S. credit strategy at BNP Paribas. Megan, thanks so much for joining. Commercial real estate, the default rates, I'm going to just cut to the chase. From where I sit as an amateur reading, it's grim. Is it grim?
We would agree commercial real estate is going to be one of the more rate-sensitive parts of the market, and we will see defaults rise there relative to other sectors. I think looking at defaults and delinquencies already across the board, corporates and consumers, the areas where we're seeing problems so far have been in these most rate-sensitive areas, commercial real estate, where we see risks building and growing, leveraged loans, another place, floating rate interest payments have seen defaults rise to 5% recently. And then also on the consumer side, recently with the Fed's data that we got this week, you saw revolving credit delinquencies for credit cards creep a little bit higher. So commercial real estate, definitely a well-flagged area for weakness.
We've been talking for the past couple of days. What kind of stability do people need to see in benchmark rates to gain confidence to come up with business plans, for corporate issuers to come back to the market? And we've already seen corporate issuers seize this opportunity and flood back in. Is this enough? Are these rates just fine as long as they stay here and there's some sense of stability for all of the investment-grade issuers?
To your point, Lisa, we've seen a lot of issuance this week. So for some context, yields relative to the recent peak in investment grade, 45 basis points lower, in high yield, 50 basis points lower for some of the higher quality issuers. And we've seen corporate treasurers take advantage of that and pull forward some issuance this week. Going forward, though, we do expect very muted net new issuance. So we think the incentives are very much in place for deleveraging, looking at things like M&A volumes, earnings growth, the cost of debt versus equity. All of those factors would support for less issuance next year. In investment grade, we're actually forecasting net new issuance to be 18% lower in 2024.
Given lower issuance, given deleveraging, there's a real question that Peter Scheer was raising yesterday, which is that maybe corporations won't have to pay a premium over government debt rates, given that they're being more fiscally responsible than the U.S. government, and that you could see spreads come very, very narrow. Do you agree with that?
I think for now, we actually do not agree with that. So we have fundamentals deteriorating. We still believe that corporates should have a premium over the risk-free rate. If you look at earnings, top line growth of revenue, we've started to see some weakness there. And going forward, that will mean you have leverage creep up. And you also have, of course, a main challenge next year of interest coverage. As issuers start to face the maturity wall, that is going to weigh on their balance sheets.
Window the maturity wall. That's right where I wanted to go. The idea of, like, I get commercial real estate's 5 to 7 years and you've got to refinance and all that. But in your world, what's your timeline out? Are you looking out 3 years OMG, 5 years OMG? Is it out farther than that?
So we expect that most corporates, higher quality, will be about 12 months forward-looking, and then lower quality issuers will have to refi about 18 months in advance. So next year, we think that in 2024, it will be a challenge for lower quality credit. So triple Cs, for example, will see interest coverage fall to the 10th percentile, according to our forecasts, if they refinance at current yields. Heading into 2025, you see an even bigger pickup in the maturity wall. So if we are here at high for longer.
The maturity wall.
It's out there in the distance. It's like Game of Thrones, Tom. Really dangerous. You don't want to approach that. You want to act before you get there.
Coming to a theater.
Yeah, especially if the Fed doesn't cut. All of that bad stuff. Can we just finish on the primary market activity this week? Ignore us. Don't worry. I got some messages yesterday that said things have been really hot. Demand's been great. Can you give us a little insight into how things have gone this week?
Yeah, so I think the issuance has been received very well. We were thinking around $35 billion in IG. We've seen well in excess of $46 billion issued so far. New issue concessions have been extremely low, and deals have been well received. I think it speaks to kind of the technical picture improving a bit with the rally in yield. So we had outflows from credit with the sell-off in rates, and now with some stability, demand coming back, and that's really been able to support some of the new issuance.
It's amazing how the trend supports things. I just can't, it's really instructive. It's kind of like 5% on a 30 years a problem, 466 brings back demand because people are enticed by the move and the directional move in yields and not the levels. Isn't that kind of bizarre? Same thing in credit. You start to see the rally emerge and people want to buy it.
People want to buy it, and people want to issue. They want to take this window because it looks like a window, even though 460 is, 460 percentage points above the risk-free rate 2 years ago. So at what point are we looking at narrative roulette that burns a whole host of people?
Megan, good to see you.
Thank you so much for having me.
Thank you so much. Megan Robson there of BNP Paribas. If you're just joining us, talking a lot of fixed income, equities look like this on the S&P 500, positive here by 0.1%. In fixed income, yields are higher by 5 basis points, 454. But to Megan's point here, Lisa, primary market activity really starting to build up in credit this week. Great demand, taken down pretty well. Seeing a similar story develop in the Treasury market so far this week.
We have seen buyers line up, and the question really is this sustainable, and is this with the backdrop of companies, yes, bringing forward issuance, as Megan was saying, but not planning to sell all that much later, right? This is basically the chance that people have to lock in this kind of duration, like Tom with his Austria bond, for a prolonged period of time at yields that are the best.
So do you anticipate, with your skill in this, do you anticipate another mega deal from these high-tech flyers?
I don't know.
You're so excited about Apple coming to market.
No, I don't mean Apple could be any of them.
Coming up
I don't mean any
day.
Does Berkshire Hathaway take bonds? I don't know. I just
50 basis point move on yields, and it's like, everyone get back here.
I know.
It's amazing how sentiment shifted. Stephanie Roth of Wolf Research reacted to jobless claims in the next hour. Jobless claims about 45 minutes away.
In terms terms of big tech. I think the strong get stronger. What I see out in the world is a much different environment in terms of the growth that's happening. And I believe tech, to your point, you're going to see the strong continuing to dominate. And I think in terms of AI, we are just in the early stages of monetization. I think that's a big thing in this tech bull market.
Drum roll, breaking news. Dan Ives of Wedbush, he is still bullish on tech going into year end. And why not after the week we've just had on tech? The NASDAQ 100 with a big week of gains. 9 days of it now on the NASDAQ. Equities right now shaping up as follows on the S&P 500. Can we deliver another day of gains? The equity market positive by 0.1%. This equity market rally inspired by this monster bond market move with 50 basis points lower than the highs of a couple of weeks ago. At the close yesterday, Tom, a break of 450. This morning higher by 5 basis points, but way off the highs of 5+% a few weeks ago.
I get the yield linkage here and some other oddities going on. We haven't even talked about UATA speaking in Japan. I got a 162 euro yen. But it's sort of like a big sigh of relief that things are unfolding and some of the mysteries are being cleared up. And so you say, okay, but maybe equities are moving on their own accord and not just because of bonds.
Have the mysteries been cleared up? Or have we just seen a big move in the bond market that people have taken comfort from?
That's the speculation.
And we'll get to see more data a little bit later. Jobless claims coming at 8:30. And I would point to a line, I keep reading, Renaissance Macro, Citi, I see this in research everywhere at the moment, that the labour market is no longer a reason for this Fed to be hawkish because of the rebalancing we've seen. And the likes of Jan Hatzius over at Goldman, Tom, when they say the hard part is over, they're basically saying it's easy skiing from here to get inflation back towards 2%.
Bramo's squirming over there.
Without much pain.
I'm really just thinking about what you guys are talking about. What happened? What's changed? Is it just that no monsters have come out of the closet, right? I mean, is there basically a wall of worry that's been hanging out there?
Walls,
is the Fed
ones,
different walls, right?
Walls.
That's a good question. That's a good point. There's
the
yes, you did the Game of Thrones wall. You've got this wall of whether or not the Fed is going to keep hiking rates. You have this wall of inflation. You have a wall of potential reacceleration in the labor market. None of that's come true. And then you had the wall of worry about Treasury issuance, and we had that sort of allayed a little bit yesterday. And is that sort of feeding this sense that maybe we can lean into this into year end?
I'm just so pleased I sit between you both. You know, just a bit of separation. Probably a good thing. You know, keep it together, TK. You've got this.
Right
Do you want
now,
to read the next intro?
And I'm going to do it because we're all standing around, those of us short, and the triple leveraged all cash fund, that's really worked out the last 9 days as well. To give you a brief on things moving higher is someone who understands concept of technology, not only the finance. He is Alex Webb in London, and this is without question our tech interview of the day. Alex, it's just as simple as this. It's about fear and greed, and just to pick Apple, if you loved it at 193, you're really going to love it here. Who's buying these stocks? Who's making these ginormous market cap stocks move? Who are the buyers at the margin?
I mean, presumably it's all the people who have seen the way that even when we think there are problems with Apple, it still manages to put out numbers that are not bad. It manages to consistently beat expectations. Even as some of those expectations come down, it still throws off a huge amount of cash, which obviously in the current climate is very, very attractive. It's very hard to discount Apple. Actually, if you look at some of the multiples of which it's trades about 28 times, I think last time I checked, it's forward earnings. It's a bit of a premium to the market, of course, but it's not anywhere near the sort of 50 to 60 times forward multiple that we see on Amazon. It's actually very close in multiples to Disney, and that's a company that people have had hesitations about in recent months, given the way that its investment trajectory has changed.
I mean, I look at Microsoft. Okay, I guess they've won at AI. John, have they won at AI?
I don't think anyone's won per se just yet. Winning in the eyes of investors,
but
possibly.
It's like it's an American movie, Alex. You don't know it. Butch Cassidy and the Sundance Kid, and they're looking off in the distance, and we're looking off at tech, the new tech, and we're saying, who are these guys? Who is this new tech that we have to buy shares of every single hour?
Look, we're so early in this AI race game, whatever you want to call it. Barely we're probably even just approaching the first hurdle in horse racing terms. At the moment, AI is a cloud product. It is a way, when we think about generative AI, we think of ChatGPT, Google Bard, and the things they're based on, Lambda and GPT-4. Like, these are products that the likes of Google and Microsoft are using to sell their cloud products. If you want to be using these generative AI models, you need to be using Azure, probably in Microsoft's case, you need to be using Google Cloud. There is going to be so much more that comes in AI that is a lot more sophisticated, a lot more specialized to whatever your company's end purposes might be. That is when we start to get into the second and third and fourth hurdles, and we'll start to see new names coming out of the woodwork. And it won't necessarily just be these massive monster mega tech firms that are the beneficiaries.
It makes the smartphone business right now sound a little boring, Alex. So let's talk about the smartphone business. ARM came out with some earnings yesterday after the close. The revenue outlook, the midpoint of that outlook, a little bit lower than expectations. In some people's minds, speaking to a slowdown in the smartphone business. Talk to me about what's happening on that front for the likes of Apple. The numbers we've seen more recently, Alex, is that a reflection of increased competition, a difficult market? What is it?
I mean, look, it's a number of things. Firstly, there is some competition in China. We've seen Huawei come out with this phone that was a lot more advanced than anybody thought would be possible for a Chinese company to manufacture domestically, thinking particularly about the chipsets they've managed to develop. That's a little bit of a headwind in what has historically been one of Apple's biggest markets. We're also seeing general slowdown in purchase of smartphones. That's a lot of it to do, yes, with consumer sentiment and disposable income, but also the pace of innovation has slowed. There's not so much more that we're seeing at the moment, and what can be done with that hardware. There are some software innovations. Like AI is a software innovation, a lot of it. There are some hardware pieces to it. Increasingly, we're going to see more AI functionality brought into smartphones. There is actually quite a lot already that we're not quite fully aware of without thinking about it. The way that they sort pictures and things on your phone is often done with an AI model. Those three factors put together, the headwinds, the consumer sentiment, and the slower pace of innovation is hurting the market as a whole.
There is a feeling, Alex, that Apple is the most leveraged to the consumer cycle, to the economy, and the others are a little bit more independent. In particular, the cloud service providers like Amazon, like Microsoft. Do you think that that's going to hold true come next year? That this is essentially going to be the theme, that these are going to be havens on the way up and on the way down, even as some of the others splintered away, like Apple?
Apple, yes, it is sort of slightly yoked to consumer sentiment, but it does play in a different space than a lot of the other consumer electronics companies. There's a little bit less price sensitivity. There's some, but there's less price sensitivity among Apple consumers, and Apple has managed very effectively to build out its services business, which is higher margin and is recurring revenue that you get month after month after month. That has been a big success. Now, it isn't in that enterprise space in quite the same way that Microsoft is with its cloud business and its sort of panoply of other offerings, and that makes it perhaps a little bit more vulnerable in some senses. That might be why it's not trading at an overly generous multiple when you look at some of those other big tech names. But as ever, you can never discount Apple. They always somehow manage to pull something out of the hat.
Alex, appreciate the update from you and the team over in London. Alex Webb there on the latest on a smartphone business for big tech as well, after some stellar gains for big tech so far this year. Year to date, to see Nvidia up by 218%. I mentioned Meta up by something like 165%. Tesla, Tom, up by 80% year to date. Off the high, sure, right. But still, there are some stellar gains year to date.
Away from our addiction to index funds, I'm just going to look at one of the sell-side debates here, and this is Apple, Tom Forte, D.A. Davidson, and you mentioned Mr. Ives at Wedbush as well. And that span off the Bloomberg screen is $166 out to a share price of $240, and Ives even indicated farther out he's modeling $270. There's a huge debate about what Alex Webb just spoke of.
Well, Ives is talking about this big upgrade super cycle smartphone business going to keep steaming on. I think Tom Forte's pushing back against that, Tom.
Yeah, and he's not alone. Let's be clear, Forte's not an outlier. There's a lot of people that are just saying this puppy's not going to move.
Just want to squeeze in a bit of news regarding Apple. I'm not sure if you saw this, Tom, but the Apple co-founder Steve Wozniak reportedly hospitalized in Mexico City. That's according to press reports. Conflicting reports as to what's behind that, Tom, but I think we all wish him the best and hope for a speedy recovery.
Yeah, it is. I mean, this guy's iconic, and it's all wrapped around the tragic early death of Steve Jobs, and he's been visible. He's been an acolyte, I think, for technology in what was years ago an absolutely unique way. He's never gotten the credit that he should have got. We all looked at that box years ago and said, are you kidding me? They're way out front.
That's the latest on tech. Coming up, Cameron Dawson and New Edge Wealth on This Market. What a run we've seen in equities as we anticipate some data about 34 minutes from now. Jobless claims in America. Yields are higher by 5 basis points, 454 on a 10-year. Equities are up by 0.1%. From New York, good morning.
The slowdown is taking place here in the United States, but it's a gradual affair.
There is volatility and possibly upward pressure on rates where we sit right now.
I think that's very much indicative of what the Fed has been telling us, higher for longer.
Everything's so volatile. We don't know where this economy's turning. We don't know what's going on there.
I just don't think we've seen the impact of rates just yet. I think it's a 2024, maybe even to 2025 story.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. The stock market, a meld up, maybe not. Maybe it's a grind up. We'll see 8-9 days in a row. Green on the screen right now. Futures up 7, and we're leading. Our team is put together. This is unbelievable, John.
What have we got?
Who we've seen in the equity space before we go to the bond space. We had Morangi. We had Julian Emanuel, and we're going to speak to Ms. Dawson here in a moment about their enthusiasm for equities.
Well, the first 2 out of those 3 constructive. We'll see if we make it 3 out of 3, Tom. I think a lot of people constructive, given the moves we've seen so far over the last week. You said 8-day winning streak on the S&P, make it 9 on the NASDAQ. Can we lift again in today's session? TK, the outlook already, the happy talk going into 2024. Goldman Sachs, the hard part is over.
The important
is it easy from here?
Important Goldman Sachs. A Krispy Kreme note just out moments ago. I'll have to look at that here on the break. I need to go to the bond market because people are saying bonds better, auction better. Auction talk at 8 a.m. on Bloomberg Surveillance. Let's go to it. Ian Lingen at BMO Capital Markets channels Bramo with a very important statement here. New 30-year auctions have a very long history of tailing. I have no idea what tailing is, leaving the only directional impulse from the event, the magnitude of said tail. While a concession is clearly awarded, the final auction of this refunding series means Bramo will shut up. There's Ian Lincoln.
Only you could turn this into comedy. Only you could turn that into comedy.
Auction comedy. Go with it, guys. Fabosi, thanks for watching. Help me here.
Okay, thanks for setting me up to really give a thrilling
Tell us about
thesis
the tail.
about it. Basically, it means they typically don't perform that well. That typically the prices sag after it's sold and after the issuance price is announced. Yeah. This is the question. Will this be as solid as what we got yesterday?
What did we see? Seriously, this is
to give people confidence.
I make jokes about it, but this is serious. Yesterday, the tail showed people have confidence in America, right?
The tail showed that there was no catastrophe. That's what it showed. That people, it was basically okay. I mean, I can't believe it.
This is the worst fixed income clinic that has ever aired on this program.
Can you see the head of marketing?
Embarrassed.
Can you see Bramo as senior VP fixed income and the marketing guys going,
all right,
Lisa, don't
let's clean
use
this
the word
up. Kit
catastrophe.
Juice. Here's his headline this morning and his word this morning, Bramo. Yields in the dollar have peaked. Frustration levels haven't. How frustrating are the next few months going to be?
That's very well cleaned up.
Thank you. I'm trying my best.
It's really good. You did great. This is going to be maybe a sense of calm. If you get a lack of any kind of huge run-up in yields like what we saw over the past few weeks, maybe people can solidify around some sort of thesis.
I want to get to the data check, but this is important. We've had a running domestic here this morning on Bloomberg Surveillance, and this is the emotion that's out there. Can you imagine, seriously, can you imagine an equity strategy team or a bond strategy team trying to get to the end of the year outlook right now? There's some serious domestics going on Wall Street.
Good luck to them.
Yeah.
Good luck to them going into 2024. It's difficult to get to year end. I'm just hoping Cameron Dawson doesn't walk off the studio floor in a moment. Stick with us, Cameron. Let's get through the price action. Equities on the S&P positive here by 0.2%. A lift here in the equity market, Tom. A lift for yields too. We're up by 5 or 6 basis points. No drama though. 455. A break of 450 yesterday. Crude in the 70s. 76 up by 0.9%. Brent crude yesterday, Tom, with a break of 80. So those 2 points I keep going back to. A break of 80 on Brent crude briefly and a break of 450 on the 10-year briefly, just taking away from some of that inflationary fear over the last couple of weeks. Whether that turns into demand concern is going to be something we can talk about through the next week or so.
We haven't mentioned this. Next week, CPI and retail sales have to be a profound confirmation of this, perhaps. John, moments ago, pure green on the screen, the VIX is in. We're up 8 on futures, Dow 66, and the NASDAQ 100 just turned green as well.
There you go.
First time this morning.
It could be day 10 for the
Perfect
NASDAQ 100.
setup right now. Let's get to it. Cameron Dawson, as we had Marenghi and Emmanuel as well. Are you a confirmed bull, Cameron?
I think that given the setup into year end, we can expect some kind of Santa Claus rally just because of tax loss dynamics into the end of the year. The largest weights in the index are up the most this year, which means that you don't have eager sellers to recognize tax gains. This is very different than last year, where the largest weights in the index were down a lot, people sold them, and you effectively puked into the end of the year.
Okay, you what?
It's the proverbial puke into the end of the year.
Oh, okay, thank you. Can we say that on radio?
We just did.
We just did. Cameron, seriously, Warner Brothers Discovery yesterday puked, as you call it. Okay, how is that handled by tax loss selling?
Well, I think that it will magnify as we go into the end of the year. You look at the areas that are down the most. This is small caps. This is cyclicals. This is healthcare, some of your defensives. These are the areas where people are looking for tax loss harvesting opportunities. The key point, though, is that they're smaller weights in the index, or they're not part of the index. So when we just look at the S&P 500, that could be something that supports it into end year.
So help me here. Am I buying the index, the S&P 500, and am I looking for buying opportunities in small caps, the financials, things that have struggled? What am I doing?
I think that you have to look for opportunities and things that have struggled as you go into 2024, because we know that pain trades usually are reversal trades in leadership. And just at the point where everybody throws in the towel and says, well, you can't own anything but the Magnificent Seven, these are the names that give you optionality on AI, and they have the best earnings growth. Everybody crowds into them. That's typically the moment that's when they start to lag. And so I think we have to have the imagination that other things could do well in 2024 other than just the narrow leadership that we've had this year.
Torsten Slock of Apollo is writing questions for us this morning. This is the question he's asking in his most recent note. Everyone who's bullish on equities and lower rated credit should ask themselves where they think the labour market will be in 3 months, with the Fed on hold and not showing any signs of cutting anytime soon. What's your labour market bet with that in mind?
We are having the ultimate debate is if we're seeing normalization or we're seeing weakening. And the challenge is that normalization is usually the gateway drug to weakening, meaning that you see a little easing that turns into a lot of easing, but we're not yet seeing definitive data yet to say that the uplift we've had in unemployment is going to barrel higher. The key thing to remember, though, the Fed itself in its SEP, the Summary Economic Projections, has unemployment going to 4.1% next year, and they're not forecasting a recession. So that's going to be a key question of if we get that 4.1%, does that justify them easing policy?
Is it okay to sort of say we don't care for now? Down the line, whatever happens will happen. In the meantime, we can dance in the head of a pin with oil prices coming off, yields coming lower, and risk appetite still available.
Yeah, because if we think going into CPI next week, remember that gasoline prices are down 10% over the month of October. That's very different over the summer months where gas prices were up a lot. It pinched consumer spending maybe a little bit at the margin. So that does create this beneficial environment. But I think it's important to remember 2022, we priced in the earnings recession in 2023. 23, we priced in the earnings recovery in 24. What are we going to price in 2024 as we look to 2025? Are we still confident that this entire economic setup can remain very strong, that unemployment won't be an issue, consumer spending can remain robust?
Given the lack of certainty around some of the outcomes, the potential outcomes with the economy, how nimble are you remaining? How are you remaining nimble to be able to adjust quickly?
I think we have to remain completely nimble. We saw that over the last couple of weeks where we went from deeply oversold to getting close to being overbought. It means that technicals become really important. We can't get too lodged into narratives because narratives would have told you everything's ending back a couple of weeks ago, be scared. Now the narratives are saying everything is fantastic. The thing is that we are at resistance when we look at technical levels. 4,400, very important for the S&P 500, 4.5%, very important support for the 10-year. How we interact with those resistance and support levels will be very indicative of the next couple of months.
Speak to the people who listened to you and said, okay, I'm really nervous, but I'm going to participate in this market, and they own tech, which literally on an hourly basis has a bid right now.
Yeah.
What's the character of that bid on the Magnificent Seven?
Well, it's extraordinarily strong, but then think about the difference in the setup. Going into 2022, Magnificent Seven earnings had been cut by about 20% over the course of the year. Now going into 2023, over the course of 23, Magnificent Seven earnings had been revised higher by 60, 70% on average because of the better growth that they've had. So it's a much higher bar, and I think that's where the discipline is not trying to extrapolate too much of the experience of 23, get too crowded, and instead look for opportunities in areas that might be more left behind.
You've been talking, Cameron, about how difficult it is to follow the mood because it swings so massively from week to week. How much has the move that we've seen in yields underpinned your conviction that you can lean into the rally heading into year end?
It certainly has helped. We've seen it play out in the valuation, and now valuations are back to about 18.5 times earnings. The question is that the right valuation, even given where yields are at 4.5%, where that equity risk premium is? The challenge with valuations, though, is they are terrible timing tools, and that they have no predictive power on a one-year forward basis. So we can look at the market and say, hey, it's expensive here, expensive there, but that may not actually show up in price action for 2, 3, 4 years. And that's where that discipline of not chasing very high valuations comes in when you have a longer holding period.
Have you got breaking news, TK, on donuts? Is that where you want to go?
Donai, plural.
Donai?
Yeah.
What's the
Long
news?
ago and far away, the way a prime broker attracted a hedge fund
was donuts.
We can get you shares of Krispy Kreme to short. There's in the East Coast particularly, and the Krispy Kreme's a more southern thing, and they're a different donut than what you get from Dunkin' Donuts, which is, there's cultures here, John. It's like Greg's, but it's like American.
Okay.
All of a sudden, Krispy Kreme, nice video. On radio, you are missing the making of the magnificent. And the answer here is Krispy Kreme is looking for a partnership with McDonald's. John Tower out with this, and it's a mixed story of EBITDA out there, but John Tower at Citigroup says first bite on DNUT. It's a McDonald's partnership that we may see.
Do you know what you don't know? And I know this story already because Bramo shared it with me before. Bramo breaking into the news industry in Fargo years and years ago for the first Krispy Kreme shop. True story. True story. True story.
True story.
True story.
I covered it, and people lined up. They camped out overnight to get the first Krispy Kreme
Bramo
donut.
went to interview them. You can imagine how what Bramo was like in local news, right?
I thought this was local news.
Just go and do a fluff piece, please, Lisa.
And I was like, it's an investigative piece. What are they doing with that money? And how clean are the facilities?
Unreal. Bramo in Fargo.
Yeah, I'm enough of a Dunkin' Donut, Krispy Kreme is just too sugary and sweet. Like Cameron Dawson, help us out here. Krispy Kreme or Dunkin'
She's
Donuts?
never had a donut.
There is nothing better than a hot, fresh Krispy Kreme donut.
Ooh.
Straight from the fryer. Nothing better.
All right, they're screaming at me.
In the control room, sot that, please. Let's be sure. We're running at 9 o'clock today. Look for Cameron Dawson on Krispy Kreme donuts.
If you're joining us now, welcome. You've missed out. Equities right now positive by 0.2%. Makes me think about this story. You see Lilly? This is so confusing.
I miss this.
We need to talk loads about this. So they've undercut the price of Novo with this newly approved weight loss drug Zepbound. The drug maker said it plans to charge more than 21% less, or about $10.60 a month, so $1,060 a month for its shot, which will hit pharmacies after Thanksgiving. Wait for this. This is what kills me about this story. Lilly also already sells the same drug for diabetes under a different brand name, Mounjaro, that retails for around $37 less a month. Can someone it's the same active ingredient, Bramo. What's it about?
I have no clue. Is it insurance?
I don't know.
Is it marketing? I have no clue.
If it's about diabetes, it costs one price. If it's about weight loss, it costs another.
Policy prescriptions? I don't know.
We got to get Sam Fazili on this. Seriously.
Yeah,
we got to
good to see you.
Good to see you.
Good to see you. Don't run. Cameron Dawson, New Edge.
Would you like
New
a
York
donut?
City.
Yes, please.
This is Bloomberg.
In the last debate, she made fun of me for actually joining TikTok while her own daughter was actually using the app for a long time. So you might want to take care of your family first.
Leave my
before
daughter
preaching to
out of your
anybody else,
voice.
adult daughter. The next generation of Americans are using it. And that's actually the point. You have her supporters propping her up. That's fine. Here's the truth.
You're just
the easy
scum.
answer is actually to say that we're just going to ban one app. We got to go further.
Tense exchange there. Republican presidential candidates Vivek Ramaswamy and Nikki Haley feuding on the debate stage yesterday evening. That was quite a fight, Tom.
Ugly.
You're just scum. It's quite a line from Nikki Haley to Vivek Ramaswamy.
I'm sorry, we all deal with this, Bramo and I and everybody else, John,
So are you doing a commercial breaks with each other?
No, you can't. You can't drag your kids into this at any level of debate.
Totally agree.
It's like
totally agree.
Third rail.
Totally agree. That crosses a line.
Yeah, it crosses a line. In America, it crosses a line.
I think it crosses a line worldwide, Tom, for that matter. If you are just joining us in your equity market at the moment, we are positive by 0.2% if you round it up on the S&P 500. Going into some important data, I think. Jobless claims just around the corner, 13 minutes away. Tom, we get some jobs data in America.
It's going to be important. The economy here really just front and center. There's been a dearth of data, but I'm going to drive it forward, John, to CPI and retail. I thought they were important a week ago. I would have blathered on about them. After this equity lift and the bond market move, I can't fathom the reset we could see with some outcome of those two key reports.
Andrew Hornhorst of Citi saying the same thing, that ultimately Chairman Powell so far seems fine with the strong growth we had in the third quarter.
Yeah.
Pointing to a labour market that, from their perspective at the moment, I'd say the consensus on the committee doesn't see that as a reason to be hawkish any longer. The word to Neil Tutter over Renaissance Macro. I think we still have to ask the question when we look at inflation data, what are we converging to? And Andrew Hornhorst of Citi thinks we're converging around 3 and not 2. And when Jan Hatzius of Goldman is talking about the easy part being over, we've been talking about the last mile of this inflation fight being the hardest, and it's from 3 to 2. What are we converging to, TK, going into next year?
The convergence. Well, going into next year, are we there yet? Do we have a clue of January, February of next year? I don't think we do.
I don't know.
Given geopolitics,
people have got to write that outlook, haven't they?
Yeah, I just don't see it. A huge response to our donut discussion. Thank you so much for that. We'll summarize it here through the last 45 minutes of the hour. The 9 o'clock show with John Ferro will be donut-free, we're told. That's a good time to speak to Anne-Marie Horton, who's gluten-free, down in Washington, Bloomberg, Washington, correspondent. No donut talk today, Anne-Marie. I've got to go to this, Anne-Marie, because we brought it up here. There was a line crossed last night at the GOP debate. What is the ramifications of this bitterness that we saw in discussion with the governor of South Carolina?
Well, I think everyone was prepared for this, right? There's been a number of moments where Vivek Ramaswamy and Nikki Haley have had these tense exchanges. Yesterday, it felt like it went maybe a little bit over the line for some because Vivek Ramaswamy brought in her daughter to that. Remember, Vivek said that TikTok is fentanyl for social media, and then he joined TikTok. And he says this is because he wants to make sure that he's reaching these young voters, and this is where they get their news. But she's a foreign policy hawk. He goes after her and brought in her daughter, and she had a lot of issues with this. He also called her Dick Cheney in 3-inch heels, and then she corrected him and said they're actually 5-inch heels. I can run in them, which was a dig at Governor Ron DeSantis, if you're following all this controversy around whether or not he puts lifts in his boots or not. And then she also said they give me ammunition. So these were the tense exchanges. But overall, this debate was a bit more substantive because there was less individuals on the debate stage. And Greg Valliere says that's the point of this. Right. A lot of these individuals we're going to start to see them really wane out. It's not going to be these 5 potentially in the next one.
Yeah, it's real sensitive for me with the lifts I'm wearing as well. Anne-Marie Horton.
You do not need lifts.
I'm wearing them every day. Anne-Marie Horton, help me here.
I need heels. Tom does not.
Help me to the 4th debate. I can't fathom how silly the 4th debate will be.
Well, I think it depends who's going to be on the stage. Greg Valliere's note this morning talking about it's really felt like it's between Governor DeSantis and former UN Ambassador Nikki Haley. But Governor DeSantis didn't mention once this endorsement he got, a crucial endorsement from the governor of Iowa, Kim Reynolds. He didn't mention that once, and that was supposed to be this, boost to his campaign. So potentially, will we see all 5 of these in the next debate? Maybe Vivek Ramaswamy, maybe Tim Scott don't make it to that. So potentially, you can get even deeper and a little bit more texture on these conversations. But we also should remember, there's a tale of 2 primaries happening. Last night, the individual who is way out front of all 5 of these candidates was having his own rally about 10 miles away in Florida. and that's the former President Donald Trump.
It's amazing that we haven't really talked about foreign policy all that much, given how much that's dominated the headlines for so long. Last night on the debate stage, they were pretty hard in their line toward Iran, all of the Republican candidates. And this comes as news this morning shows that the U.S. said that they had a defensive strike in Syria on certain ammunitions tied to Iranian-backed rebels. What do we know in terms of how the U.S. government stance is evolving in that frame?
Well, I think for Iran, it's really no surprise here the Republicans want to take a very hard line. Remember, it was the Obama administration that had the JCPOA with Iran. Trump came in. He got rid of that. He wanted to take a hard line on Iran. He went after Qasem Soleimani. They assassinated Qasem Soleimani. And then the Biden administration, I wouldn't say was trying to renegotiate a full-on JCPOA, but they wanted to keep status quo and just keep talking with Iran to try to keep a lid on what is going on in the region. And what you see on stage last night is these individuals going after the Biden administration for not being hard enough on Iran, because Iran is the backer of Lebanese Hezbollah, of Hamas, of the Houthis. So that is why you are seeing tough talk, not just on China and for some on Russia, but squarely on Iran yesterday. And what this administration desperately wants to do right now, the current Biden administration, is they want to keep a lid on what is happening in the Gulf. They do not want to see this conflict between Israel and Hamas in Gaza spread elsewhere.
So how does the strike in Syria by U.S. aircraft really play into this goal of not escalating this conflict?
Well, the Pentagon has made it very clear. If we are striked, and they did say they are seeing an uptick of attacks on U.S. bases in Syria and Iraq, if they are seeing that, then they will strike back. They want to make sure that they are not just showing a deterrence factor in the Gulf with 2 aircraft carriers hanging off on the eastern Mediterranean Sea, but that they will actually strike back if they are hit by Iran or some of Iran's proxies. So they are seeing an uptick. Is that all we're going to see? And a lot of this has happened in the past. It just hasn't been really out front because a lot of people haven't been focused so much on what is happening and the tit for tat that sometimes takes place in the Gulf. But people are squarely focused on it now because of what's happening in Israel.
It's totally bizarre, isn't it? We're talking about these really serious issues at the same time we're talking about whether the governor of Florida has lifts in his shoes. TK, sometimes
American
it's just
politics
absolutely
is your politics
ridiculous.
Any stranger
I think
than
politics around the world has just got more
Yeah.
ridiculous, Tom. It's not unique to this country.
You know,
that's for sure. Which begs the question, Anne-Marie, is he wearing lifts or not? Well, why is he wearing lifts if he is?
Well, listen, there's an entire... He did an interview with someone, and the interviewer said, listen, I bought you a pair of these beautiful Salvatore Ferragamo shoes. Give them a try. And Ron DeSantis didn't even touch them. He just left them there. He said, I can't accept anything like that. There's this theory that he wears these cowboy boots and he puts lifts in them so he can look taller, because there is another theory in American politics that you have to be of certain stature in height to win. But yeah, Jonathan, it's silly. We're talking about incredibly serious issues. Yesterday on display was not just what's going on in Israel, more funding potentially for Ukraine, where they all stand on that. Should the U.S. raise the retirement age? What are we doing in terms of Social Security and entitlements? Yeah. Where are they all standing on abortion, which, if you're a Republican running, you have to realize what is your message going to be on abortion after Tuesday night's elections in Ohio, in Kentucky, and in Virginia. And yet, there's also a little bit of silliness.
We're talking about lifts. I watched that clip, by the way, with Patrick Bet-David on the Ferragamos. AMH, thank you. Anne-Marie on the latest down in Washington, D.C. TK, you're a man who does not need lifts. What are you, 6'5"? 6'6"?
It depends if the children need money. Yesterday was an ugly day. Yesterday was my iPhone broke.
Whenever I meet someone and they meet me in person for the first time, the number one thing they always say, you're so much taller than I realised. And I'm like, yeah, because I sit next to a giant every single morning.
Yeah, pretty much.
Towering over us. Coming up on Bloomberg TV, Mohammed Al-Arian, George Bory of Allspring, Matt Miskin, John Hancock, Joanne Feeney, at Advisors Capital Management. That all still to come in the next hour.
Bloomberg Bloomberg surveillance from New York. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Mr. Ferro in deep preparation. Donut discussion with Dr. Ilarian. He'll do that in the 9 o'clock hour. Futures up 9. Green on the screen. The VIX in as well. And Lisa, this gets to the data next week. CPI, retail sales, and the data now.
And you said something really important just moments ago when you were talking about how we are set up into next week and the vulnerabilities to data that surprises to the upside with respect to inflation.
You have to see there. I take the 4-week moving average. Michael McKee doesn't do that. Head of Bloomberg Jobless Claims Analysis, and he joins us with the numbers.
I got so many job titles now. It's news correspondent. 217,000, really kind of no change from last week. Waiting for the revision to come up, but basically no change in jobless claims. Here we are, 220. So we go down. Go figure. It's not a surprise that we see claims go down with the auto strikes over, but continuing claims still a little bit higher, 1,834,000 after 1,812,000. And so that may be something of a hangover from the jobless claims, from the auto strikes as well.
Set us up. I want to go right to next week, Mike. How is next week's CPI retail sales combo in your world, not the equity world, bond world, in your world, how is it different and to be treated?
Well, it's a little bit different in that we have a lot more data to come before the next Fed meeting, including another CPI report. So this will be informative, but it won't be dispositive. The Fed's going to look at it and they're going to wait and see what PCE does and then what the November CPI does before they have to make a decision.
Will it inform on soft landing?
Not necessarily. It will inform. That's a good word for it. Retail sales are expected to go down for the month of October, although the control group up just a little bit. It'll depend on whether people want to go Christmas shopping early. Last year they did. This year, I guess analysts don't think they're going to be doing that. And CPI is forecast to go lower as energy prices go lower. So that would keep the Fed on track at least to a soft landing and to the idea of not raising rates again in December.
Let's inform with the data check. VIX drives lower here, a more optimistic VIX off the data, 14.39. Red and green on the screen, pretty much a churn off what we see before. Lisa, do you see any bond love here off jobless claims?
No, there's a little bit of a bid back, particularly at the front end. And basically the idea being, again, we didn't see any monsters come out of the closet. We didn't see a massive tick up in jobless claims. And I wonder if that's enough to give people conviction about some sort of soft landing. Mike, to that point, what will it take, considering that we are looking at something that does look like a soft landing, but it always looks, as I'm sure you're going to say, I hear a lot of people say, like a soft landing until it isn't?
Well, that's the problem is, how do you define landing and when do you define landing? I was saying yesterday to Paul Sweeney on Bloomberg Radio that we should maybe look at it like George Aiken, the former Vermont senator who said of Vietnam, we just declare victory and go home. And maybe that's what the Fed ends up doing at some point and just saying, okay, we're there, because the economy doesn't ever land. It just keeps going. Now the question is, do we have any contractions or does the economy start to grow again? That might be the definition.
2 p.m. today, Fed Chair Jay Powell, he will be at the IMF panel. What do you expect him to say? What could he say that people are looking for that could influence where markets are?
I think the only thing the markets are looking at for right now is any kind of pushback against the idea of additional rate cuts. He came out at his news conference and said, we are not talking about rate cuts. We're not thinking about rate cuts. And the next day, rate cuts were priced in even greater and sooner. And so he might want to push back against that. But this is on global central banking challenges. He is with the central bank governor of Israel and Gita Gopinath from the IMF. So he may confine his remarks to global issues. We don't know. It's an opportunity for him. We'll see if he takes it.
How are you dealing with the debt and deficit debate every day? I want to know, Michael McKee, on the new percolation of our larger debt and our substantial deficit.
Well, here's the problem, Tom, is the debt we knew would get bigger. It's gotten bigger than we thought it would because receipts are down and people don't quite understand why. But the whole bottom line to it is nothing's going to get done unless members of Congress decide to go after entitlements, some kind of cutback to entitlements, because the additional deficit from non-defense discretionary spending is hardly anything, wouldn't get you anywhere. And do they have any kind of courage to do that. And there hasn't been any indication that that's the case.
Michael McKee, thank you so much. Greatly appreciate it. Really leaning into next week's key economic data. This is a joy. Stephanie Roth writes in English. She writes exceptionally direct economic strategy and reports. She is chief economist at Wolf Research, and we welcome her today. Stephanie, I just got to go right to your key point. I love how you do this, literally like an equity strategist. You have a conviction call. Very few people want to say that right now in the great uncertainty. What's the Roth conviction call?
My highest conviction call is that inflation is going to come down. And there's a couple of factors behind that. Labor supply has been a big driver of lower inflation this year, and that should continue into next year. Female participation is a big driver, and work from home is here to stay. Immigration is another factor there. And then on top of that, we all talk about onshoring as a big driver of lower inflation, but the fact is, yeah, it's true for certain issues of national security, but we're still importing just as much goods as a share of GDP as we were before the pandemic.
The key isn't just whether we disinflate. The question is until where. And as we just heard Michael McKee said, maybe the Fed just declares victory and goes home well before they get to 2%. Is that sort of what you foresee happening, or is there enough disinflationary tendencies baked in to get us down to 2%?
I think we'll get down to slightly above 2%. I don't think we'll necessarily get to 2% next year, but we'll be close enough that the Fed can certainly pause at this point and then be cutting rates in the back half of next year. And that should be, enough disinflation, especially we didn't really even talk about owner's equivalent rent. That should come down quite a bit, weighing on core inflation by about, 5 basis points or so on core PCE.
So given your high conviction that inflation is going to come down, do you have high conviction that we will not see the economic pain associated with that disinflation that a lot of people were expecting earlier this year?
That's the piece that's harder to have conviction on. We think that growth is going to slow down. Our base case is that growth is going to move below trend with a one handle in the first half of next year. Recession risks are going to be elevated until the Fed can cut rates. So our base case is that we don't have a contraction in growth. But with a deceleration in the pipeline, that could definitely be a possibility.
Frame out the Wolf Research call on real GDP out 12 months, on nominal GDP out 12 months. What are your statistics?
Sure. So we're at a little bit below 2% on GDP for next year, about 1.7, and then we're looking at inflation of about 2.2%.
Then how do you fold that into an equity call? Not that you're going to make a specific stock market call, but when you talk to Wolf Research analysts about a sub 2% real GDP, that's got to bring nominal in, right? With your disinflation call, it's got to bring revenues in, right?
Yeah, and I have to say that the analysts on balance, and of course it depends by sector, but the analysts on balance are a little bit more cautious at this point than they were at the beginning of the year. So at the beginning of this year, while the economists were all really bearish on the economy, the fundamental analysts were pretty positive.
I mean, Michael Darter was busting my chops yesterday on this, Lisa, but the line is the top line revenue of American companies. Forget about tech and Magnificent Seven and all that. It's got to be dampened if you get a Roth disinflation call with some form of subdued real GDP. It's a tautology. It's got to happen.
Which is the reason why the economy is not the stock market and vice versa. And we keep kind of parsing through that in different ways. I want to dive a little bit further, Stephanie, into this idea that you have high conviction that we're going to disinflate, but you have low conviction or not a lot of conviction about what's going to happen with the economy and how much things will slow or even contract. What are the guiding sort of lodestones for this? And I keep going back to this at a time where people are looking at oil prices and saying they've come down enough to signal a cooling in demand, but it not falling off a cliff.
Yeah, so I mean, there's a couple of things on the growth front. So when you're looking out this year, a big surprise from a growth perspective has been fiscal, and by fiscal I really mean the IRA that played out a lot faster than expected. Chip spending that resulted in structure spending being incredibly strong. That it's not going to repeat for next year. And then on top of that, we had this hidden fiscal stimulus of employee retention credits getting paid out. So all of that should provide a slower growth economy for next year, not necessarily a contraction. And then on top of that, the consumers, this excess savings concept is largely over.
So are you saying that people are underestimating how much of a fiscal boost went into that third quarter GDP print that was a wow statistic, to quote Tom, for so many people?
Yeah, I think there was an element of that. And for all of that this year, for that matter, is people just underestimated how much fiscal was actually getting spent in the economy. And some of it was related to subsidies and private companies doing the job for the fiscal, but that all played out in 2023, which is why growth held up a lot better than people expected.
This is going to be a point of a lot of debate, especially next year when it becomes politics season, silly season, as some would say. Do you think if there is this disinflation, that the fiscal stimulus will be considered successful or not successful based on the debate and where we're at globally with trying to disinflate?
I guess it depends where you're coming from, right? From a CHIPS perspective, like, we need that. It's an issue of national security, and that's particularly important. I guess you could argue some of this fiscal stimulus was coming at a time that was just countering what was happening from a monetary policy perspective,
Right.
and that was probably not needed.
How do you define soft landing? We've been going back and forth this morning, and this permutation of it and that, but it's like V-shaped bottom to me. It's just a stupid phrase. What is a soft landing?
So I would say soft landing looks like a 1-ish% GDP for the first half of next year, and then you kind of come out of it with around trend growth. The problem with soft landing and recession might look the same for a very short period of time.
It's a key phrase. There's a short period of time. And also, I think in the old days, we called that a recovery. It was like, it doesn't sell on TV or radio like it should, but it's a recovery.
Well, people say, to me, this is the uncertainty, right? And we don't even understand the fiscal impulse, which is one of the big actual mysteries going forward. And to me, that I thought was the biggest interesting takeaway. That was still one of the drivers. That's off the table, though, Stephanie, right? How much of a drag is that going to be on the economy?
It should be a pretty sizable drag for next year. You're going to have all of those things moving in the opposite direction, and that'll reduce GDP by a meaningful amount for next year.
Stephanie, we got to do this. When you got a company that's 85% in debt and they're coming out with a new offering and the stock tanks, granted it's a lower price stock, but it tanks from a 10 level down to 860. I'm sorry, we got to cover this. Talk about a soft landing. AMC Entertainment out with an equity offering. There it is, $350 million a stock. We'll have more coverage on this because I have no clue what that means. The stock moves 15%. The S&P up 0.2%.
Stephanie Roth of Wolf Research, thank you so much. Looking at this AMC news, the suggestion here is that the dilution in the shares is leading to this plunge, and I wonder how much AMC is coming out on the heels of Taylor Swift and all of the Barbenheimer trends and trying to raise more equity into maybe fewer day traders and fewer kind of to-the-moon traders who are willing to accept it on the other side, Tom.
We got 15% equity. This is not adjusted for this new offering here. And, again, it's a very small company, but 86% is the weighting of debt with a stunning, the weighted average cost of capital here on debt, the weighted average cost of debt, I should say, is 6%. That's a ginormous number, Lisa, in this milieu.
And if they had to come to market now, it would be a much more ginormous number. What I think is interesting is that this was one of the GameStop-type darlings of the era of penny trading stocks and all of that. And now the question is, they just had this incredible quarter. They've had some pretty big hits. Can they raise a bigger equity cushion? There is a cost to pay for that, or price to pay for that, as you're seeing in the market.
I look at this, folks, and you go to a pre-pandemic chart of AMC, and it's just real simple. I went from 40 to 300. I didn't buy at 300. I loaded the boat at 200, and now I'm joining it down at 10.
Did you see Barbie?
No, I'm the only one in the country who has it.
I saw it.
Did you see Barbie?
I did.
Did you see Taylor?
No, I haven't seen Taylor yet. Have you?
No. Who are you talking to?
I don't know. You're watching, anime. Who knows?
Well, that's TV at home. Taylor. We should just mention. Take a memo, control room. I'll mention Taylor every 12 minutes, so on TV we can run Taylor. Good morning, Taylor.
last time I was here, I said buying oil was not going to be a good hedge for escalation there because oil had been under so much pressure before. And I think that's what we're seeing again. There's just that lack of demand. And the Saudis definitely have the ability to turn on the tap if they want. We're clearly trying to figure out how to work with Venezuela. And so far, it looks like Iran's going to continue to pump oil despite the sanctions, despite the heightened tensions there. So there's not much in favor of oil right now. And I think that's a very crowded long position. So I could see that breaking lower.
That was Peter Scheer, an excellent conversation yesterday of Academy Securities, head of macro strategy on oil. We will get to that in just a minute. We were just talking about AMC, so let's lean into that and a couple other names that are moving in a significant way. AMC shares plunging after announcing that they are going to offer up to $350 million of stock. They say that the goal here is to bolster liquidity and lower debt. The shares lower now by 18% in pre-market trading to really quite a low figure compared to the $300.
Does it have a preferred tranche where Taylor gets to buy $350 million with an 8% coupon?
You want another, kind of
No, but
Taylor
I just
Swift
think this is, can we say
moment.
this? Is it because of Taylor Swift and her concert footage where she's dressed in blue and then beige? And
they did just have
on
a really
radio,
good...
we're running the 10 eras, Lover Fearless, Reputation Folklore video.
Well, here's the thing.
Works
They
on
just
radio.
had a good quarter, and they're capitalizing on it. What I find most interesting is that this is raising equity to lower debt. Think about what a reversal that is from a couple of years ago, where every company under the sun was raising money in the debt market to buy back shares. Right. That, to me, is really notable. We'll follow that story throughout the day. Also, just some notes. Duolingo shares popping after reporting better than expected earnings. And I've got to say, the whole family does Duolingo, so I understand this. Up more than 11%. People really hooked in. They send you updates and congratulations.
I agree. It's really game-changing. And what's so important here with the global tailors, Taylor Swift has been doing Duolingo. Well, bring up the Taylor video.
All right,
come on.
no, let's
bring it
move
up
on.
right now. Taylor uses Duolingo.
And Disney we're focused on as well after reporting earnings that were better than expected. A big question now of who they sell to, given what we're seeing with respect to ABC.
maybe Taylor Swift will buy Disney.
All right, moving on to oil prices. We could run it in another 14 minutes. We could run it in another 14 minutes, Tom. I do want to turn to oil because there's been a real question of how much is the demand side and how much is the supply side, given the declines in prices that we saw over the past month and then again over the past couple of days. Ellen Wald joining us now, senior fellow at the Atlantic Council and author of Saudi Inc. Ellen, to that point, Saudi's energy minister came out and said it has nothing to do with demand. This is just price manipulation. Demand is still very strong. What did you make of that?
Well, I think that he always has a bone to pick with as he calls them, the speculators. So I'm not surprised to see him talking about how, this is all a financial thing and it's all due to speculators and it's not a, supply demand issue. But I think, obviously there's always, speculation in the market. And we did see a whole lot of fund managers dumping oil futures this past week. So I'm sure he's focused on that. But the fact remains that the market is reacting to what it thinks is lower demand from China. And whether or not that's actually true, I think remains to be seen. It's always difficult to gauge what exactly is going on in China. What the market's reacting to was news that refining margins are soft and, Chinese refineries aren't making as much. And so, they're interpreting that as weak demand. Now, how does that translate into whether China reduces its imports? And there was some indication that they are going to be reducing oil imports. In fact, one of the interesting things that we've seen is that Iranian oil exports in September and October have been lower than they were in August. They hit a big high in August, but now we're seeing declines. And there's some speculation that may be due to sanctions enforcement, but it's much more likely due to declining demand from China. And we've got Saudi Arabia holding 1 million barrels a day off the market. I do think Saudi Arabia is in the best position to be able to gauge Chinese demand. And it may be that, yes, Chinese demand is looking a bit soft now, but, Abdulaziz bin Salman is looking at the longer picture and the longer game, and he sees that is strong.
Ellen, with great respect to your book, which was definitive, we can take these tensions at least back to the Saudi Yemeni War of 1934. The Ibn Saud family has dealt with this for pushing 100 years, the distance to the south. Give us the modern treatment of how Riyadh and Jeddah look at Yemen today.
Yemen is basically a thorn in their side right now. They don't like the Houthis. Any group like the Houthis, Hezbollah, Hamas, all of those groups, while you might think that ideologically there are similarities and matchups there, they are essentially a threat to the Saudi monarchy. The Saudi monarchy is like, they're like the staid old, conservative guy who always votes the same way and always says the same thing for breakfast. They're the status quo. And any group that's looking to change the status quo, even if there are similarities in terms of, say, religious extremism or religious ideology, that's seen as a threat. And what's a bit disturbing is that despite prolonged military campaigns by the Saudis and the UAE, they haven't been able to dislodge the Houthis from Yemen. In fact, if anything, they're more entrenched. Right. And so I do think that given the fact that the Houthis are at least claiming to be involved in the Israel-Hamas conflict, it'll be interesting to see if the Saudis maybe use this as an excuse to really try to get them out of Yemen once and for all, or if they'll be a bit embarrassed by somebody else taking them out.
And then the conservative guy, as you call Saudi Arabia, their treatment of the shades of Palestine. How do you interpret that, Dr. Wald?
Now, that is a big question, because what we've got on one hand is King Salman, who is nominally the king of Saudi Arabia, and he is vehemently anti-Israel, pro-Palestinian. I mean, this is a guy who thinks that, the Mossad was responsible for 9/11 and has said so, in public on television. So he is a huge barrier to any kind of rapprochement between Saudi Arabia and Israel. That being said, his son, who's really doing most of the ruling, the day-to-day ruling, seems much more inclined to use rapprochement with Israel as a way to get what he wants or what he thinks he needs from the United States. And in fact, it seemed like that was about to be a very successful deal before this latest conflict derailed all that. And I don't think that the general battle, the general lines that are drawn here are going to change. But I do think, if King Salman wasn't there, I think we'd see a much faster progression towards Saudi-Israeli normalization. I don't think we're going to see quite what the UAE or Jordan has, but I do think that MBS sees it as a beneficial thing, or at least a really good tool to get other things that he needs, like support for obtaining nuclear power and military pact with the United States.
Just real quick here, how does Saudi Arabia view the production in the U.S. that's gotten to a record level amid all of these concerns about demand?
I think that they have kind of come to terms with the fact that the U.S. is going to produce what the U.S. is going to produce, and there really isn't much they can do about it. I think they were probably pretty pleased to see that there's more consolidation in the oil industry. I think that they see that as good for production and for companies who are looking at the signs of supply and demand and aren't just pumping just to stay ahead the way that we saw in 2015, 2016. And so I think that they see this as, this is where it is right now, and it's not always necessarily going to be this high.
Ellen, a wonderful brief, particularly those comments on Yemen. Thank you so much. Ellen Wald, Atlantic Council. Can't say enough about Saudi Inc. It is absolutely definitive. I got equity markets with a lift, and a lift here through the morning that is tangible. Those small stocks up 0.7%, and the VIX just giving me love, 14.3. So all that is shadowed by the 30-year auction today. Bramo dead on about the 10 years. Celebrated, I would say. I would editorialize yesterday. Ian Lingen weighing in here. Let's do this one more time. It's so important. New 30-year auctions have a very long history of tailing, leaving the only directional impulse from the event is the magnitude of the tail. We go on here. What are we going to see this afternoon?
To translate, it is a question of whether the buyers show up
at the price that dealers and the initial buyers think they will.
I need a prediction. Bramo editorial.
Yesterday, we saw strength, or we saw a pretty solid auction. Today, 30-year bonds, and what Ian was saying there is a history of a little more indigestion at 30-year auctions. So it's going to be potentially more interesting to watch.
Please stay with us through the day. Our team coverage at 1 p.m. of the 30-year auction. Airbnb in the 12 noon.